candidate to announce that she is dropping out in recent days. So, Kelly, this is increasingly looking like a two-way contest between Joe Biden and Bernie Sanders, with now Amy Klobuchar dropping out of the race. Back to you.
And Elon, we were just talking to Meg about this off the top of the hour, but tomorrow is Super Tuesday. So now we've had Pete Buttigieg and Klobuchar both dropping out before that, like you said, to try to kind of coalesce support. But I wonder as well if there's going to be any impact from coronavirus, from people who might not be showing up to the polls, or from results that might have more absentee ballots than they would have thought of just even a few short weeks ago.
Well, I think one thing that's important to remember is that both California and Colorado have been allowing people to mail in their ballots for quite some time now. So it's actually going to be interesting to see what happens to those people who had voted for Buttigieg or Klobuchar previously. But we'll just have to see who ends up turning out to the polls. We also heard President Trump say that he expects his rally tonight to be completely safe and that folks should not be afraid to come out. But certainly with these new concerns, that might put a damper on the vote. We'll just have to wait and see.
Yeah, it's going to be quite a day. Elon, thank you. We appreciate it. Again, Elon Moy with the news. Amy Klobuchar has dropped out of the race. Now, it was a wild ride for commodities in February, along with everything else. Oil ended the month with its worst week since the financial crisis. And while most commodities are rebounding today, my next guest says we're facing the biggest hit to oil demand in more than a decade. For more, let me welcome in Jeff Curry. He's the global head of commodities research for Goldman Sachs, and true to his title, he's in London. Jeff, it's good to see you. And how much worse do you think it's going to get for the oil price and for demand here?
Well, I think it's hard to take a directional view on oil right now, given the fundamental uncertainty. As a result, we just don't like the risk reward for going out there, with the exception of gold, which we're positive on. In terms of thinking about commodities, one thing to keep in mind is that they're spot assets. They have to reflect today's supply and demand fundamentals. In contrast, financial markets are anticipatory assets. They can start to price, once we've hit bottom, they can price the future. Given that with commodities, they're going to be dealing with a surplus. As you pointed out, it's the worst demand shock since 08, 09. They're going to deal with a surplus until at least in the second half of this year, which means we would be a seller of most rallies.
But we do, commodities do have futures markets, and there are ways of looking to see if the curves are, kind of up or down shaped, let's say. What do you see when you look out there? Has most of the damage to the oil price been priced in now, or do people think the price is going to keep dropping?
Well, actually, commodities are the opposite of what you would think about the expectations of forward curves. When the forward curve is upward sloping in a commodity, it means you're building inventory. It means you'd have to buy the commodity today, put it in storage, and you want to have a higher price in the future to pay for that cost of carry. As a result, we look at oil. Yeah, the first two contracts are what we call backwardation on the front end, but as you look out over the curve, the rest of the curve is in a contango, which would indicate that this market is in a surplus when we start to look out 6-12 months out on the forward curve.
So in other words, it's encouraging people to build inventories right now, and that means going forward, we're going to continue to have more supply than even as that demand is dropping off. All right, so we've hit 43, I think, on the price of oil over the weekend. That's still too high. I mean, what looks economic to you? In the 30s, lower?
Well, in terms of thinking about on a Brent basis, we thought the downside would be somewhere in that 45 to low 40s, which would translate to somewhere in the high 30s on a WTI basis. But I think the key here is that the fundamental uncertainty about this and the extent of the demand damage in the developed markets is still very high. If we think about the outlook for oil, there's three things we're watching: China, ex-China, and OPEC. China, the situation, the worst is probably behind us. We think the total demand hit in China was somewhere around 3.5 million barrels per day. And we're seeing, a reduction in the overall cases. We're seeing restarts in economic activity in China. The problem is now contagion has moved to the developed markets, and we don't know the extent of it, which is why we be careful of calling a bottom right here.
So let me ask you about gold before I have to let you go. How high? The all-time high, I think, was around $1,900 several years ago. Are you seeing us go above that level?
Our target is $1,800 an ounce right now. And, versus the 1900, one thing to keep in mind, the dollar is near record strength. And when we hit the 1900, the dollar was near record weakness, which tells you just how strong gold is today in the $1,600 an ounce range. Now, there's three things we're watching on gold. The first one is you have a lot of central bank easing. We like to call gold the currency of last resort. And in the current environment, when you have 9 out of 10 of the G10 banks easing, you're going to have a lot of debasement in the currencies. Second thing is de-dollarization. Central bank demand from emerging markets remains high. I like to point out central bank demand last year was the highest since the Nixon era, representing 22% of gold supply. We don't see that changing anytime in the near future. The third reason we like gold really has to do with it's the best hedge for geopolitical risk of any sort, particularly the type that we're seeing right now with the virus. So the net of it, that's the one commodity. We have a very strong directional view. We want to be long here. And again, we're trading 1,600 with the upside target of $1,800 an ounce.
All right, so 1,800 for gold and maybe high 30s for WTI?
On Brent, I'm comfortable saying in the 40s. The thing is, when we start to go down, that differential starts to contract. So let's say the low 40s on Brent, and if the differential stays where it is, you're definitely talking in the high 30s on WTI.
All right, Jeff, it's great to have you again. Not often people, the stuff you're covering, you're not bullish on, if you know what I mean. It's great to see you tonight. We really appreciate it. Jeff,
great. We're bullish on gold.
Right, exactly. You found one in there. Thank you, sir. Goldman Sachs Global Head of Commodities Research. Well, China's manufacturing activity did slump last month as coronavirus shut down factories. Up next, we'll talk to executives of two companies with supply chains dependent on China to see how they're dealing with the outbreak and take a look at the best performing sectors right now in today's market. They are real estate, technology, energy, and financials. We should note all 11 sectors are higher, and we'll have a whole lot more on this rally straight ahead.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app to see the latest editions under the Your New Episode section. Happy listening.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow and tune in on Facebook, Twitter, and Instagram to get the most out of TuneIn.
To be a spy.
You gotta be kidding me. The lie detector test. The ultimate tell, slightest wink of an eye.
Like this? I admire all of your tattoos.
Damn, she's good.
Under the rough exterior, you're a nice guy. What is he doing?
This looks like the wedding at the end of Shrek.
My Spy, rated PG-13.
Who's ready for a great ride? Ready to work out my constipation? It's been so long.
Let's not talk about constipation.
Come on, everybody, work it out.
Say no more to occasional constipation with clinically proven effective Seneca. Satisfaction guaranteed or your money back.
At Outback, Steak and Lobster is back. Oh, no, it's gone. Phew, it's back with lobster mac and cheese. It's gone again? Oh, it's back with shrimp now. Steak and Lobster starting at only $16.99. Hurry in before these three are gone again. Outback Steakhouse.
She worked with Travis Bass, Ricky Williams, that's Hilliard, and Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed tonight, 10 Eastern. CNBC. Get yours.
You went to college. You're smart. So why are you getting ripped off on your student loans? At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month by refinancing to a lower rate. Don't get ripped off on your student loans. Let's focus on your future, not your debt.
Visit Credible.com and in 3 minutes, see how much you could save.
These folks, they don't have time to go to the post office. They have businesses to grow, customers to care for, lives to get home to. They use Stamps.com. Print discounted postage for any letter, any package, anytime, right from your computer. All the amazing services of the post office, only cheaper. Get our special TV offer, a 4-week trial plus postage and a digital scale. Go to Stamps.com/try and never go to the post office again.
Welcome back to The Exchange. The coronavirus outbreak in China is shutting down Chinese factories and wreaking havoc on supply chains for a wide range of companies here in the U.S. For more on this ripple effect and what it will mean for the U.S. economy, I'm joined by Lou Lenteni. He's the CEO of Echelon Fitness. And Josh Lorzel is Vice President of Sales and Marketing at Hog Wild Toys. And both of these gentlemen depend on China for manufacturing their products. It's great to have you here, both of you, on a day like this. Lou, I'll just begin with you. What can you tell us? As I read here, at some points, the supply chain has been almost entirely shut down. How is the product availability looking for you right now?
Well, the coronavirus happened during Chinese New Year, where they have a few weeks, 2 to 3 weeks off. So it extended that Chinese New Year and kept everyone out of the factories. The good news is we got our first shipment shipping last week. So shipments are starting to move. Even when you produce, our factory is 100% back on board, but you have all these different suppliers, and some of the suppliers are not coming on board yet, but they are starting to come on board. So it's getting much, much better, and we're going to see about a 30-day lag time on some of our deliveries.
So 30-day lag time, but so far no major shortages. You're not changing pricing or dealing with price changes at all?
No, we fortunately prepared for Chinese New Year, and always for Chinese New Year we always stock up with heavy inventory. So we thought that was a fortunate thing that it happened during that time frame, not before Christmas, obviously.
And so people are aware Echelon's a pretty high-end product. I hate to compare you to Peloton, yes, but that's effectively what you are.
We're $1,000 to $2,000, half the price of our leading competitors. But, we haven't seen any problems. But the biggest concern we have is the trade shows. A lot of trade shows are being canceled in our industry. The Canton Fair in China is being canceled. There's a show in Taiwan for sporting goods being canceled. And one of our leading customers is not going to the fitness show in San Diego.
So those
coming
are business
up.
Leads perhaps lost.
Business opportunities are going to be lost and delayed.
Okay, so Josh, let's turn to you. You're on a much different end in terms of the price spectrum. These are toys. One of these kind of reminds me of my lacrosse game growing up here, the Pop and Pass. Interestingly enough, both this Pop and Pass and Birdie Golf, which are some of the products you manufacture, could they be helped because you have some availability of this product at a time when retailers are desperate to put stuff on shelves?
Yes, Kelly, absolutely. And before I get to that, I just want to say, you heard it first on The Exchange. Christmas is not canceled. There will be toys for Christmas. But there were short-term challenges we faced in terms of delays on outdoor toys specifically. For summer, that would normally be shipping now. And then maybe like in a month to 6 weeks would be on shelves at Walmart and Target and those places. So there's a delay in the outdoor products, and so some of the larger retailers were reaching out to all their suppliers here and saying, hey, who has domestic inventory that we can grab now available? And then luckily for us, we brought in our products early at the end of last year.
And that was just by coincidence? Or?
Honestly, it was because it was a new category. The outdoor summer toy market was a new area that we wanted to go into. So we just happened to bring them in early last year, and so we're sitting on a warehouse full of product in Portland. So we're like, yeah, we have stuff to sell you.
Right,
so it's good for us.
You can take advantage of it. So let's talk about what you're seeing on the ground. When our producers first spoke with you, you said your factory in Guangdong was running at only 15% of capacity, and you're up to where now?
As of today, we're about 50% capacity. There's challenges with a lot of the sub-suppliers actually delivering everything from the screws you need, blisters, packaging materials, all these extra things that you need to finish your product. There's delays there that we're seeing about 30 to 60 days, so not close to what we're seeing also.
Same question for you, because I imagine you're also a little more price sensitive, trying to keep your prices of this product down. There's maybe less margin there, although maybe not. Maybe you have plenty of cushion. Are you dealing with price spikes? Are you going to have to pass those along at all? And are you dealing in general with delays and a lack of supply that will be coming in the months ahead at this point?
In general, we plan on keeping prices the same. We'll probably eat some margin loss on our side, but we don't foresee the prices like going crazy or spiking at all for fall. Again, I think the supply chain for Christmas, which is the most important in the toy industry, that will be pretty much, it should be fine.
What would you say people need to know, Lou, about what's happening in China right now?
Well, I think the Chinese actually, unlike you've heard from a lot of people, I think they've dealt with this tragedy pretty well, and they've put a lot of systems in place. When I've been going to China for the last 3 or 4 years, ever since SARS, you walk through any airport, you get a temperature gauge on your head. So you can't go in unless they make you remove your hat. So we put those type of systems in place in our factories. Everyone has to clean their hands. Everyone has their temperature checked. We disinfect the factory once a week, fully disinfect. We clean all door handles every single day. So they put a lot of things in place. And I also mentioned to you about the WeChat on their chat thing, where they're making people not go into certain areas if they've been in infected places.
We have to go, Josh. I just want to ask you, if the slowdown comes to the U.S., is that a bigger problem for you at this point?
Because we have most of our product already here, we're in a good position where we can continue shipping. And I think Amazon, we were talking about this off air. Amazon's, for both of us, is a big channel for us to get product to the consumer. So I think as long as Amazon's running, we can still sell them at least. But
all right, and get those delivery guys out there.
Yep.
All right, guys, thank you both. Really appreciate it. Much more robust view of what's going on. Again, Josh Lorzel and Lou Lenteni. Well, the Dow has shed 4,000 points in the past week, but is posting a big rebound today as investors bet stimulus is on the way worldwide. Is this a real turnaround? We'll ask. Here are the best performers on the NASDAQ 100 today. JD.com, Tesla, Costco, and Gilead leading the way. We're back in 2.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
And also find answers. Our search to transform farm waste into renewable natural gas led Chevron to partner with California Bioenergy, working to provide an alternative source of power for a cleaner way forward.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it.
They were able to restore my good name.
Visit reputationdefender.com or call 1-877-866-8555.
My hair loss was a reminder of my age.
Like, is this happening to me now?
When I started first seeing results, I got excited.
I love my new hair.
It makes me feel a lot more confident. The things I love about Roman are the simplicity, the confidentiality, and the fact that it works.
It's tough to quit smoking cold turkey. So Chantix can help you quit slow turkey. Along with support, Chantix is proven to help you quit. With Chantix, you can keep smoking at first and ease into quitting. Chantix reduces the urge, so when the day arrives, you'll be more ready to kiss cigarettes goodbye. When you try to quit smoking, with or without Chantix, you may have nicotine withdrawal symptoms. Stop Chantix and get help right away if you have changes in behavior or thinking, aggression, hostility, depressed mood, suicidal thoughts or actions, seizures, new or worse heart or blood vessel problems, sleepwalking, or life-threatening allergic and skin reactions. Decrease alcohol use. Use caution driving or operating machinery. Tell your doctor if you've had mental health problems. The most common side effect is nausea. Quit smoking slow turkey. Talk to your doctor about Chantix.
The biggest day of the race so far. 14 states and over 1,300 delegates in play. We'll be with the campaigns at the big board, breaking down the results of Super Tuesday. All-day coverage tomorrow on MSNBC.
Welcome back. Quite the rebound in the market today. We're off the highs, though. The Dow was up 815. At that point, we're up about 690 right now. Most of this action in the past hour. Investors are betting that central banks around the world will be riding to the rescue. So is this a real turning point, and dare we say a bottom? With us is Steve Grasso. He's Director of Institutional Sales at Stuart Frankel and a CNBC contributor. Steve, again, it's tough to try to call the bottom unless you feel like you want to kind of go that direction. Maybe we'll just focus on what the market is expecting out of this G7 meeting tomorrow.
Yeah, I don't feel comfortable that anyone should be calling a bottom just yet. I did feel comfortable on that 28.55 level in the S&P cash. I think that was a near-term bottom. But when you look at the overall market, we had a pension fund rebalance on Friday, Cal, and there was a huge amount of stock that needed to be bought. I think you're seeing after effects of that, and I think you're seeing the predominant effect of that G7 meeting that you were just talking about.
I mean, there is a lot priced in. Let's remember, in order to get today's rebound, we have to basically price in 75 basis points of Fed cuts in 2 weeks, plus some kind of coordinated central bank action tomorrow. What are you looking for? And my point being, how much disappointment might there be if we don't, if they don't deliver?
Right. So if you look at the G7 conference call that I think the market is getting ahead of today, I think that's the big question mark. I think the other headlines of the day is President Trump trying to, get the pharmaceutical companies, the drug companies to kind of put a hard press on developing a vaccine or developing treatments, and also the pressure that's going to be put on our Fed to do something proactive ahead of this. So to your point, I think there's a lot that the bears are going to need to contend with over the next couple of days or so. But I do believe the mortality rate and the fatality rate, although it's terrible for people who are suffering from it, still not something that the market should be factoring in, because when I was looking at, and when the world was looking at 2 to 3% mortality rate, now we heard from a guest on Squawk Box this morning that's probably 0.2% to 0.4%. So it's just a worse flu, and I don't think that the market should be factoring in this much to the downside if that's what we're really battling with.
All right, that is the latest thinking with this rebound today. Steve, it's good to see you. Thank you, sir. Steve Grasso, that does it for the exchange. I will see you on Power Lunch. Over to Brian.
Yes, you will, Kelly, and we will see you in just a moment. I am Brian Sullivan. Welcome, everybody. Stocks, as you can see, they are surging. Investors, they are hoping that central banks around the world will keep money cheap and help ease credit. The Dow up 730 points. Now, this move up, denting a bit of the damage from last week, but the major indexes are still in a corona-induced correction. We're going to have your playbook for what is next. And the markets, they may have got 99 problems, but a rate cut is not one. Investors pricing in a nearly 100% chance of a 75 basis point rate cut this month. Power Lunch begins right now.
Brian, thanks. We are seeing a big bounce back on Wall Street today, and we've got all angles covered for you. Bob Pisani is watching the rally down at the NYSE. Rick Santelli is out in Chicago seeing new lows on the 10-year yield earlier today. Meg Terrell has the latest on the coronavirus, and Steve Leisman on whether the Fed will come to the market's rescue here. We begin with stocks and Bob Pisani with the very latest. Bob?
Kelly, we're just off the highs. The question is, why? Why are we getting a nearly 800-point rally? And there's two essential reasons for it. Let's just take a look at them. Number one, we have extreme oversold conditions. We'll explain that in a minute. And number two, we have hopes for fiscal stimulus and hope for coordinated monetary stimulus around the world. And there's indications that those are coming together as well. There you got your rally. Just take a look when we say extreme oversold conditions. This is the relative strength index. It shows you how much the market momentum is moving in the last couple of weeks. 19, when you're below 30, that's extremely oversold. When you're 19, that's stupidly oversold. You very rarely see this. It's a screaming buy on a traditional way to look at the markets. Another extreme indicator, we have NYSE, the volatility index here. We were at 49. That's almost 4 standard deviations away from it normally is. Here's 50 and even 80 back in 2008, but we never saw those levels ever again in history. So when you get up here, usually within a short period of time, the market will move down again. Then we look at NYSE new lows, nearly 1,000 on Friday. That's almost 40% of the New York Stock Exchange. You don't see that very often. That's the highest since December 28. Another screaming indication of at least a market bottom temporarily. And then we have high yield, enormous outflows from high yield funds in the last several days, and a lot of spreads blowing out here. You see that decline. This is the biggest high yield fund, HYG. All of it says indications you should buy at this point. And here's the problem here. Even while these indicators flash a buy, yes, new lows, yes, extreme VIX readings, yes, traders had a deer in the headlight looks all throughout the weekend. This was the big debate. How do we know that this is an accurate signal? It worked in the past, but maybe this is one of those black swan events like 2008, and we're all going to continue to see the market decline and get our head handed to us if we buy. Today, these ideas are indeed working, and a lot of people are breathing a bit of a sigh of relief. Guys, back to you.
Yeah, good stuff there, Bob Pisani. A lot going on, certainly. Well, as that is happening, also earlier today, we had a new low for the 10-year yield. Rick Santelli's at the CME. And Rick, I guess the question is, with all this bond buying, is it people just short-term parking their cash because they don't know what else to do? Or is this some sort of weird optimism about government bonds?
You know, I think it's a little bit of nervousness, so they're parking their cash, and I think they're parking their cash right next to many other investors, maybe due to demographics or just negative rates throughout the globe, who have also parked inside the Treasury sovereign complex. All sovereigns globally are big parking lots. Ours just happens to be one with positive yields. And if you look across the curve, we're down 10 in 2s, we're down 7 in 10s, and we're down 4 in 30s. Why do I bring that up? Because there's no way we're closing any of these in positive territory, which means an 8-session record of lower closes, and for long end, each one of them is historic. Look at a 2-day of 2s. A year to date of 10s, it just jumps out at you. October 1st of dollar yen. This is interesting. Look at how much the dollar has suffered against yen, going all the way back, comping October. The dollar index is lost in the last 7 sessions 2.5 cents. That's like a 3% loss in 7 sessions. Finally, a year to date of the euro versus the dollar, same thing as the dollar index in reverse. Where's all that selling in the dollar index gone? Well, some of it in the yen, an awful lot of it in the euro. Kelly, back to you.
Rick, thank you very much. Rick Santelli, the World Health Organization, not yet calling the coronavirus outbreak a pandemic, pointing out that 90% of the cases are in China, mostly in one province. But the spread outside of China, including here in the U.S., is growing, and Meg Terrell has more for us. Meg.
Hey, Kelly. The WHO noting today that as cases in China are declining, they're still rising in the rest of the world. New cases in other countries today were almost 9 times higher than those in China. Of particular concern, Korea, Italy, Iran, and Japan. In the U.S., numbers are rising quickly as well as state and local labs get the ability to run their own tests. New cases of community transmission in California, Oregon, and Washington state, where officials are tracking an outbreak at a nursing facility where one patient has died and more than 50 residents and workers have symptoms. And in just an hour, we'll see pharmaceutical executives head to the White House for a meeting on vaccine and drug development for the coronavirus. The CEOs and heads of research of Regeneron, Gilead, GSK, Moderna, Pfizer, Johnson & Johnson, and others are all included. And just 30 minutes ago, guys, we got an update on Regeneron's timelines for a potential drug. The company says it aims to have hundreds of thousands of doses for human testing beginning in the late summer. That was at the Cowen Research Conference in Boston.
This is a treatment or a vaccine type of?
It's primarily designed as a treatment, but they say it could be used for prophylaxis or prevention as well. It's an antibody-based approach.
We need both, right? I mean, that's the thing. We've got to remember this story. We want the treatment for the people that are infected now. We want the vaccine, which would ultimately, what did somebody say in Squawk Box the other morning? We don't need a rate cut. We need a vaccine.
We need a vaccine. Right. Vaccines have longer timelines right now, at least as what we're hearing, potentially a year until we even get into human trials. Not until we get into human trials, but until we get a vaccine that could be deployed more broadly. But treatments could potentially be a little bit earlier.
Because if they get one, they've got to make it, then they've got to scale it, and they've got to distribute it.
That's right.
Still, that's been one of the better stocks in this big sell-off. Regeneron has been, of course, on these hopes.
Also related to some Novartis news on a competing eye drug.
Oh, good. All right, Meg, we appreciate it. Thanks.
Well, meantime, the overall markets and the president and some of his staff want the Federal Reserve to come to the rescue. In fact, some out there seem to be counting on it. Steve Leisman joining us now with more on that.
Yeah, it could be a big part of this rally today. Brian, expectations for aggressive intervention by central banks rising as faster than the new case count for the coronavirus. Multiple Fed rate cuts seem to be priced into the market here. A lot of talk about a possible emergency cut. That is one before the March meeting on the 18th. Speculation by J.P. Morgan and others that you may see of zero Fed funds rate when all is said and done. But recession for most economists, not the base case. These expectations are showing up in dramatic shifts. Folks, these are moving all of the time. What I'm going to show you is 15 minutes old. I guarantee you it's moved since then. But right now, looking at this, zero chance of a 25 basis point cut, a 25% chance of a 50, and a 75% chance of a 75 basis point cut. Kelly is shaking her head. We'll get to the head shake in just a second. But the Fed funds is seen plunging. If you look at the trajectory for where the market is putting the funds, 1.6 now on the Fed funds, 0.9 after March, 0.6 or take away a full percentage point is the expectation in the market by July. In a joint statement, the IMF and the World Bank pledging this morning to help member nations and provide financing as needed. The governor of the Bank of Japan taking a page out of Powell's book, issuing an extraordinary statement saying that pledging to provide ample funds. And finally, attention turns to tomorrow. It reports that the G7 finance ministers will hold a conference call that looks likely to include central bank officials. So there is a lot going on, a sense that, I think I said this in the last hour, the cavalry is mounting the steeds here finally. Maybe they should have been done last week, but maybe it wasn't apparent what needed to be done. Now it looks like the different bureaucracies and agencies are getting moving in terms of creating the groundwork for addressing the potential economic fallout here.
But is that steed secretariat or a 30-year-old nag? Is there any juice left in that central bank tank?
I think there is, and I think if I could follow the metaphor to the logical ad absurdum, we need a couple Clydesdales here, reliable, dependable. I think the combination of central banks, G7 finance ministers coming out with a statement pledging assistance on both the fiscal side and the monetary side as needed, I think these are among the things that got the market's attention today, and I think these are among the things that, look, you cannot undo it all, but you can have programs in place that try to ease the pain that will happen, people's real lives from the economic fallout from this.
Steve, stay right there. Let's also bring in Ishwar Prasad, a senior fellow at Brookings and a professor of economics at Cornell University. You might have read his piece in the New York Times. His op-ed is called "The Coronavirus Has Put the World's Economy in Survival Mode." Ishwar, it's good to have you here. You know, Steve just mentioned, and I do think this is kind of the central debate right now, that maybe there's going to be a fiscal and monetary policy response. What do you think is most likely tomorrow and in the weeks ahead?
Haven't we seen this before? Central bankers being expected to save the world. Certainly a combination of fiscal and monetary policy at this stage would do a few things. It would calm nerves. It would mitigate the downside risks. But is it really going to give a significant boost to growth that is going to be enough to offset this negative shock? That's a little harder to see. The problem is that even if there is significant stimulus coming from both central banks and from fiscal policy, it's not obvious that businesses or consumers are going to go out and spend that money given all the uncertainty that's still lurking out there.
Right.
But
So
certainly this will put a bottom on how bad things could get, and that is very important at this stage.
The major debate right now is whether monetary policy is the right tool. Now, there are those who say, look, the neutral rate, let's just call it, you know, what the economy needs is the neutral rate has fallen, so therefore the Fed has to respond, and it doesn't really matter what the cause is. What would you say to those folks? And what about the idea that, look, maybe there could be something on the fiscal side that could help improve the economy's prospects a little bit better?
Now, monetary policy is a lot easier to implement, and the one beneficial effect is definitely going to have is on financial markets, and we've already seen some of that today. Fiscal policy, I think, is going to be much more effective if it can be targeted. Many small businesses are hurting. They're going to have cash flow problems. Consumers are going to be hurting. So if you can get money effectively into the hands of low-income consumers who have higher propensities to consume, if you can get it into the hands of small businesses, that's going to hurt. But is it really going to make up for a demand deficiency? Not quite. But certainly having monetary and fiscal policy work together and having a coordinated response across countries, that is all going to help in terms of mitigating the damage. And like I said, that is really important at this stage where things could spiral out of control if we don't see some action.
Yeah, well, right now the markets are spiraling up. In fact, we just were on session highs. The Dow is up 805 points. But Steve Leisman, I want to quote that great poet warrior, Steve Leisman, back to Steve Leisman, which is, you said something, I think it was last Friday. Is a rate cut going to make you feel safe going to a rock concert?
No.
Or getting on an airplane?
No, it will not. But look, let's be clear about some of the things. And I think Ishwar is maybe, what's the word I'm looking for, unduly pessimistic in that if your goal is that the stimulus should undo all of the damage, then I think your goal is set wrong. And if that's the goal, then certainly the stimulus will underperform. But let's say there's stimulus in place that keeps businesses that are good businesses that otherwise would not go out of business from being called on their notes and their loans. Let's say you have loans or stimulus out there that would keep other defaults or spirals from happening in markets. In that case, no, it doesn't undo it all. It doesn't cause people to not go to rock concerts or get on planes. But I mean, what about certain businesses in the travel business, Brian, which you're very familiar with, or the energy business that would otherwise go out of? They could potentially go out of business. I was supposed
to fly to Houston Sunday for a conference. I got
if there's 6 months of a decline in demand, some of these businesses could go under, and there's a legitimate question as to whether or not there's a role for government to come in and say, you know what, let's put a floor under that. Let's stop that pain from happening that otherwise shouldn't happen. We're going to have to deal, as Ishwar suggested, with perhaps dramatic declines in supply, dramatic declines in demand in certain businesses. But let the government come in and do two things. Put a floor under the damage, but also put another side to the trade, because that's when markets get into trouble.
Ishwar, can you address whether the Hong Kong approach would work best or better here with the idea of, basically giving citizens about $1,000 in cash, giving them maybe $2,500 off their income taxes, providing kind of electric breaks in their electric bills and some business breaks as well. You said something very telling a moment ago, which is that monetary policy is easier than fiscal. Well, I wonder if that's why we keep coming back to a central bank solution, even though, as Goldman and others and Steve have said, it might not be the most effective.
I think to pursue Steve's point, the key question is how best to limit damage at this stage. Certainly the big supply disruptions, the fall in demand cannot be fully counteracted, but maintaining people's confidence at this stage is very important. There are certainly small businesses that are going to fold if they don't have cash flow. There are consumers that are going to be in very precarious circumstances if they don't have money in their pockets. So even if they're going to stash away some of the money they get from the government, I think seeing governments act in concert, using all the elements and policy tools at their disposal is really important at this stage. It may not have a huge bang for the buck, but certainly it could prevent a much worse outcome, and it's really crucial at this stage.
I add one quick thing, which is that Olivier Blanchard did a 180. He was the former IMF chief economist, and they found out that the multipliers to government assistance at a time when the global economy is in crisis are much higher than we thought they were. And I think that's an important lesson. We thought that it was less effective. We found out afterwards it was more effective, more essential, had more bang for the buck than we initially thought.
All right, Steve, thank you very much.
And Ishwar Prasad, we appreciate it as well.
Thank you.
All right, let's get back to these markets, shall we? Because Wall Street may be betting big on some near-term support coming from the central banks, what we just talked about. And stocks, they are surging today. The Dow is up 800 points, and volumes across the market and ETFs are sky high. And while lower today, don't lose sight of the fact that the so-called fear gauge, the VIX, hitting its highest level in nearly a decade last week and is still well above where it was a couple of weeks ago. Let's bring in Jeff Mills of Bryn Mawr Trust and a CNBC contributor, as well as Burns McKinney, portfolio manager and managing director with Allianz Global Investors. Thank you. Jeff, are you the one driving this market higher today, or are you advising clients to sell into this strength?
I wish I was. I think what's driving the market higher today is really a technical snapback. The rubber band got pulled really far in one direction. Bob Pisani was on earlier talking about it, but you can look at any number of measures. I mean, last week, 90% of stocks in the S&P 500 made one-month lows. You had 4 days in a row of the put-call ratio in the 95th percentile. So some pretty negative sentiment in the options market. And I actually thought it was fascinating. If you looked at flows into levered ETFs that are betting on the market going down, they were ridiculous. I mean, last Thursday, some 300 million shares purchased. So I think taking all of that in combination, the market was bound to snap back at some point. And I think that's what we're seeing today. The problem is we're still pricing in uncertainty. It's not even risk. Risk can be calculated, analyzed, probabilities assigned. I think the spectrum of outcomes is so wide here that one trading day is not going to resolve all of our issues. So we're telling our clients just to sit tight for now.
Yeah, and all those people who bought those, 2 and 3 times inverse the market ETFs are getting something handed to them today, and certainly that may be contributing out there. But Burns, I mean, you're a long-term player. I get it. You want to buy low and sell high, or just keep buying low. What are you buying today?
Well, we're really looking at equities in 2 areas because, we are at a point now where the markets can embrace risk. You have 3/4 of the S&P 500 companies yield more than the 10-year Treasury bond. And so there are some rewards for taking risk. And, looking at it in 2 ways, almost a little bit of a barbell approach. The first bucket being look for names that actually, if the health scare does get worse, they're going to hold up a little bit better. Companies with high dividends, companies with stable earnings, and more important than anything, companies with clean balance sheets to allow them to weather the storm. And so, we're looking at some of those names, like some of the telecoms, maybe the defense companies. And then on the other side of the coin, there's a lot of really, top-notch, high-quality, industry-leading companies that are now on sale. And so, likewise, look for companies that, you might be able to get good values with these names that are, trading at much steeper discounts to where they were a couple of weeks ago, that are going to actually, come out a little bit more strongly on the other side.
Burns, what do you make about the level of rates here? Because it just seems like no matter what's happening in the stock market, if this extremely low period of low rates persists, does that, how do you interpret that? What is your advice to clients?
Yeah, I mean, I think that, a lot of it's just, supply and demand. The supply of yielding alternatives is very low. At the same time, the demand is very high, and you have money flowing in not just here, but as well from overseas, looking for yield anywhere they can get it, which, again, I would reiterate, probably makes a really strong case for companies that are paying dividends, because whereas the Treasury yield, that's a stable yield versus, you look at U.S. companies, they have dividends that have a track record for growing faster than the rate of inflation. So that's one of the things we're really, stressing to our clients and looking for in our portfolio, or those dividend growers are probably a great place to be in this type of market.
Jeff, when will we know that the all clear really is sounded? It's not today.
I think it is really so hard to know. I mean, obviously, looking at, some of the progress of the virus and whether that's peaked or not. But I think once we see that, it probably will be too late. So I think for now, you have to start to look for areas of the market where most of the pain has already been priced in. We actually have a Monday morning call. We talk about the markets with all of our advisors. So I was flipping through some data this morning. If you look at the differential between growth stocks and value stocks and the valuation disparity that has developed just really over the past, say, 6 to 8 weeks, typically growth trades at a premium of about 3.5 times to value. Right now, that's almost 8.5 times. So just to put that in perspective, that's almost 3 standard deviations for growth being expensive versus value. So to Burns' point, I think you want to look for places within value where you can actually find prices that reflect a pretty negative scenario. Even in energy, names like Cheniere, you have 80% of their marketable volumes in long-term take-or-pay contracts. RBC is valued just those contracts at $66 a share. That's way above where the stock's currently trading now in the low 50s. So there are pockets of value with individual names and just in the value style in general, given the valuation disparity that we're seeing.
All right, Jeff and Burns, a great discussion, guys, on a big market day, although a little different than we've seen in the big market days, Kelly, of the last few days.
Yeah, now this one's up.
All right, well, as you can see, stocks are rebounding today in a big way. Right now, the Dow is up just about 800 points. And coming up at the top of the hour, the president, the vice president, and the entire coronavirus task force will meet with pharmaceutical executives at the White House. Tomorrow, however, that attention will turn to the travel industry, hit harder than perhaps any other, when the president will host CEOs of the cruise lines and the airlines. Phil LeBeau joining us now with more on what we can expect from that meeting, and a group that definitely, Phil, needs some help.
Oh, well, they definitely do. Look, the airlines don't know, and I can't speak for the cruise industry, but definitely with the airline industry, Brian, you're looking at an industry that's unsure what the demand is going to be, not only over the next couple of weeks, maybe the next month, but going out 4 or 5 months down the road. So what you're seeing with the airline industry right now are a number of things. On the international front, there are select international routes like to Milan that have been halted by a number of carriers. Some major corporations are suspending non-essential travel. And increasingly, I'm hearing from people who are saying, I was supposed to go on a work trip. I'm not going. And we're now seeing airlines offering more cancellation waivers. American Airlines, a good example of this. It is waiving change fees or cancellation fees for tickets that are bought between now and March 16th. What about United? It is postponing the hiring of its next class of pilots. Remember, they're in this ramp-up mode for pilot hires over the next several years. Well, they don't know if they're even going to be able to use all of their pilots right now, so they're not going to be hiring this next class of pilots. And finally, to take a look at Southwest, what's interesting here is that Southwest shares, along with Delta today, actually moving a little bit higher. Now it's ticked a little bit lower, but was positive shortly. Evercore ISI upgrading Southwest to outperform. Basically what they're saying is the domestic routes from Southwest, it offers the airline a buffer. But make this clear, guys. Nobody knows exactly what the demand picture will look like for the airlines, let's say a couple of months down the road. They're fairly confident that it'll be there, but there's some weakness there.
All right, Phil, just sit tight for a second. I believe we might come back to you. We've got some breaking news right now, an update on the number of cases here in the United States. Let's get right back to Meg Terrell for that. Meg.
Hi, Brian. News out of Seattle and King County. They are reporting an additional 3 deaths there among some new cases. 4 cases there they are saying are new. 2 of those people have died, they say. And in addition, 1 of their previously reported cases now has also died. That brings the total number of cases there to 14, including 5 deaths total, which is the total death toll for the United States right now, guys. Kelly, back over to you.
All right, Meg Terrell. Let's get back to the airlines, which are under pressure here. We want to bring in a former airline CEO who managed through a big crisis before. Gordon Bethune is former chairman and CEO of Continental Airlines and a CNBC contributor. Gordon, we turn to you because, look, anyone who dealt with 9/11 from the airlines has certainly been through a really extremely tough period. What about coronavirus? What should the airlines do? How should they think about getting through this period financially?
Well, obviously, they've got to adjust quickly to the loss of revenue, which is tremendous. Losing a route, you don't have any of that revenue. You do have all the expenses, but they have a limited ability to adjust expenses as quickly as the revenue dissipates. But that's what they're trying to do with partially paid leaves, maybe returning lease aircraft early. It depends on how long this drags out. But they have a limited ability, which means their balance sheet and their cash is a management issue for them, not just long-term profitability.
Yeah, and the airlines with the higher debt loads are the ones that have performed worst lately. What do you do as a CEO if you're dealing with a high debt load and a demand shortfall and supply issues? I mean, how do you address all those concerns?
Well, and that's a tough thing, and it depends on how your expenses are locked in, whether it's variable with the airports that you lease space from, the airplanes themselves, and, of course, your labor. And all of those have remedies for traumatic things that happen, but they're fairly severe. So you try not to go to default or close to default type of remedies and deal with them. But that's, like you say, on multiple fronts. Everything quits. But revenue needs to come in the door because expenses are still occurring just like always.
Gordon, would you fly right now?
Oh, sure. I went to North Carolina just this weekend, came back yesterday. There's more people die from the flu every year than this coronavirus. The people that we just heard about, I'm sorry to say, because I lived in King County, but that was an assisted living home, which people are fairly advanced age and not, they're vulnerable. But I think healthy people like yourselves, I mean, you might get a case of the flu, but that's not the end of the world. And I really think this will be put in perspective as it kind of mitigates, as it grows, it mitigates.
But I hear you. And next week is spring break week for my kids, and everybody we know is planning to go somewhere. And I can tell you this much, Gordon, of just the 5 or 6 families that we have just texted with or talked to in the last 48 hours, all of them are rethinking their plans to go. Is that silly? Are they being overly cautious?
I think parents have to be cautious, and they're the ones that need to make those tough decisions. If you're going to Florida for spring break, there's nothing wrong with Florida. There's nothing wrong with spring break. And this country of 320 million have 5 people who died on the West Coast. I don't think it's really a threat to your children. I would go back to being normal, and I'd get on the airplane tomorrow if I had to go to New York for a meeting. It's not here. It may get here, but I don't know how bad it's going to be.
Well, I guess one semi-upside, Gordon, is that jet fuel prices. I just looked this morning, about $1.65 a gallon. They're normally about $2 a gallon last year. Delta, United, American use about $9 billion a year in jet fuel costs. That's each, by the way. Do you think that 17, 20, whatever % drop in jet fuel costs will offset all of some of their travel worries, some of their travel concerns?
Not all of them, but some of them, and that's welcome news. Obviously, jet fuel is a big percentage of the airline's expense, so your main driver is fuel and people, and so that's a very big help to this. But I really believe it's going to tone down by the time it gets to be prevalent in our country, because it will be put into perspective that it's a disease, but it's not fatal necessarily, and it can be managed, and our government being really open, I think, and giving us the information as it develops.
Gordon, thanks for joining us today. We appreciate it.
Glad to do it. Thanks so much.
Gordon Bethune.
All right, well, on deck, speaking of, oil is actually a little bit higher today, but let's be clear, still slammed on the year, and the stocks hit even worse. But with OPEC set to meet later on this week, should you place any bets on some big names in oil stocks? We're going to find out. And a closer look at how stocks have tended to act when we have seen big moves like this in the past. First, as we go out, let's take a look at the retailers. Costco, Target, Walmart, all soaring today. Consumers rushing to the stores, perhaps to buy up essentials. We're back on Power Lunch right after this.
This isn't just any journey. It's the first day of a new beginning. At Amica, we believe in life's extraordinary experiences, so much so that we built a company around it. With every phone call, every quote, every claim, we're an insurance company that delivers an experience that meets the only standards higher than ours. Yours. Experience Amica. Auto, home, and life insurance.
Wednesdays at Outback, they're for steak and beer. Walkabout Wednesdays are back. Get a sirloin or chicken on the barbie, fries, and a draft beer or Coca-Cola, all for just $10.99. Hurry in. Wednesdays are for Outback. Outback Steakhouse. Aussie rules.
Guys, if you wake up feeling fat, bad back, heartburn, tired, then it's time to get healthy and lose weight with Nutrisystem for Men.
I'm healthier, I'm stronger.
Lose up to 13 pounds and 7 inches overall in your first month. Money back guaranteed. Order now and we'll rush you Nutrisystem for Men.
Not only did I lose 60 pounds, I don't snore.
Act now. Buy 1 month, get 1 free.
Go online or call 877-344-FIT5 right now. Buy 1 month, get 1 free.
Consistency can deliver on investment goals. Columbia Threadneedle Investments.
New York State is building for the future of your business with a nation-leading $150 billion commitment to infrastructure. We're creating state-of-the-art, 21st century transportation hubs, constructing new bridges, bringing high-speed internet to every corner of the state, and committing to low-cost clean energy. With infrastructure built for the future, the companies of tomorrow can thrive here today. See your future at esd.ny.gov.
Next on Squawk Box, coronavirus fears, market volatility, dilemmas for investors. Should you buy, sell, or sit tight? Some strategies to get you through the turmoil. Squawk Box tomorrow, 6 a.m. Eastern. Watch and listen live on the CNBC app.
Welcome back, everyone. I'm Sue Herrera. Here's your CNBC News update at this hour. The U.S. Supreme Court will not hear a challenge to the federal ban on bump stocks. That ban went into effect a year ago in response to the Las Vegas mass shooting, where 58 people were killed by a shooter using bump stocks on his weapons. Employees returning to work at the Milwaukee brewery, where a worker fatally shot 5 colleagues before taking his own life. Molson Coors says it has added additional guards to the facility and is also offering counseling services to employees. Brexit trade talks getting underway between Britain and the European Union. Negotiators are on a tight schedule. UK Prime Minister Johnson threatening to walk away from the talks if there's no significant progress within 4 months. And paramedics dressed head to toe in protective gear standing guard at polling stations in Israel, where residents who are under coronavirus quarantine are voting in today's elections. Israel has about 5,500 people under home quarantine due to the outbreak. You are up to date. That's the news update this hour. Brian, I'll send it back to you.
All right. Thank you very much, Sue Herrera. Now, let's get over to Seema Modi for Trading Nation. Seema.
Hi, Brian. The financials, one of the sectors posting a sharp rebound today, but the group is still 14% off their recent highs and talk of a Fed rate cut heating up. What is the trade here? Let's bring in the Trading Nation team. Ari Wald of Oppenheimer, Chad Morganlander of Washington Crossing Advisors. And Chad, whether central banks are the answer to coronavirus fears, lower rates aren't necessarily a good thing for the banks. That hurts their net interest margin. So what do you make of those stocks right now?
So, Seema, we would be underweight financials at this point in time. We think that net interest margins are going to suffer not only in Q1, but Q2 and potentially Q3. Also, credit markets as well as capital markets, we believe, will be struggling over the course of the next 90 days. So overall, we would be moving up the quality spectrum. And in fact, we would shift to our overweight, which would be consumer staples.
Ari, tracking the charts, what do you make of financials?
Listen, I know this is a segment on banks, but the opportunity in financials right now is in security exchanges, data services, and private equity companies. If you think you missed these stocks on the way up, guess what? Here's your opportunity, all those stocks correcting into key support levels. Now, in terms of the banks, indeed, interest rates are the wild card. You got to be selective. The one to own, indeed, J.P. Morgan. That's the quality stock. To really make that case, look at the chart of J.P. Morgan versus the financial sector. Indeed, it's been weak of late, but all within what is still a longer-term trend of outperformance. For comparison purposes, check out JP's, one of its biggest peers, Wells Fargo, versus the sector, also weak of late, but within what could be a resumption of long-term underperformance. JPM over Wells is the call.
And both of those stocks are up 1.5%. Ari and Chad, thank you for joining us. And for more Trading Nation, head to our website. Follow us on Twitter at Trading Nation. Kelly, back to you.
Seema, thank you. And let's get a check of broader markets right now. The Dow is up about 820 points at the highs. We're up 674 right now. We are still over 26,000. That's a 2.6% gain for the Dow, and it is the best performer today. The S&P is up 2% to 3015. That's a 60-point increase. The NASDAQ up 2%. The Russell only up about 1.1%.
Also right now, the oil market is closing for the day. Let's go now to Eric Chemi at CNBC Commodity Desk. Eric.
Hey, Brian, that's right. You can see all of this green right behind me. Crude prices getting a boost today. WTI and Brent, they're each up more than 4% on the day. Today's gains were fueled in large part by the growing expectation that OPEC will announce further output cuts as it aims to curb any demand impact from ongoing coronavirus worries. Vladimir Putin said over the weekend that Russia would continue cooperating with OPEC cuts, but Russia's large financial reserves don't, quote, eliminate the need for action. Weak factory activity data released over the weekend by China was a drag on oil prices earlier in the session. Brian, back to you.
All right, Eric, thank you very much. Well, the coronavirus outbreak is wreaking havoc with corporate events. The massive CERAWeek oil conference planned for next week in Houston was axed yesterday. The OPEC meeting right now is still on in Vienna, and investors are hoping for some kind of big cut from the group. But what about the stocks? Well, they've been absolutely bludgeoned. Along with investor portfolios, bring in Michael Bradley from Tudor, Pickering, and Holt. Michael, I was hoping to see you in person next week. I guess I will not, but we do appreciate you coming on. Listen, you guys do fantastic work. I know you probably haven't slept in about 3 weeks. Are there any oil companies that you see that have just been dumped out with everything else that simply don't deserve to be?
Hey, Brian, as you know, we've been really pressing the haves in the energy industry. Those are names like Concho, Devon, Pioneer, Fang, Parsley. Those are the have-nots. Those are the guys that have, net debt to EBITDAs less than, 1.5 times. Don't really have any debt walls that are coming due over the next 2 years. Those are where we want to stay. Those things have been pounded. It's been very indiscriminate. That's where we want to concentrate our money.
Yeah, and it's all about net debt to EBITDA, right? I mean, if you're out there and you're thinking, wow, these companies have been whacked, I think 27 are down 50% or more this year, according to the last time I ran the data. Probably changed a little bit today. It's all about debt, right? You look for the ones that don't have as much as anyone else, and if you wanted to buy some, those are them.
Yeah, we're not really seeing anybody like gravitating down to those names at this point in time. As you know, the biggest issue for the market right now is what is demand going to look like this year and what's it going to look like next year. And with those debt walls out there, and especially in the next 30 to 45 days, you're going to see some of these banks are going to be redetermining their banking lending standards to these companies. 4 or 5 months ago, those the commodity price deck that they had there was high 40s, low 2s. Obviously, WTI is much lower now, and natural gas prices are much lower now. So those companies are going to continue to get the vice set to them.
Michael, I just have a question since you're in Houston. What happens to the Houston economy if oil stays at $45 a barrel or goes to the high 30s, as Jeff Curry of Goldman suggested last hour it could?
Well, we're not seeing that much of an impact, but, the one thing that we're hearing, and obviously Brian brought up a little while ago, is the CERA conference was canceled. I know with our firm and other people that we talk to, investors that we talk to, behavior is going to be changing here over the next couple months. And so we expect demand's going to be down. That's not going to be good for pricing. That's probably not going to be good for Houston real estate, but we're just not feeling it at this point yet. But there definitely is going to be a change in consumer habits over the next couple months, and that's just going to be a net negative.
Sure, and I'm not surprised because in a way this move in the oil market has happened so quickly. I mean, it's basically just been a month or two of this plunge, and so I'm just curious, based on kind of the recent past, what happens when we get down to this level? Because for the U.S. overall, low gas prices don't help as much as they did for the consumer, and the low energy prices do hurt one of the stronger parts of the economy where you are.
Yeah, well, you look at it right now. There's going to be a big benefit for consumers with the lower natural gas prices and lower crude prices. As it relates to the companies, there's going to be a lot of companies are going to be laying people off. Right now, Tudor Pickering, we expect that there's going to be CapEx cuts this year of 15%. given where prices are now, it's going to probably be closer to 25 or 30%. That means you're probably not going to be growing U.S. production next year. There's probably going to be additional headcount reductions coming, and so that's not good.
No,
we're just not feeling it yet because it come down so fast.
Well, we did, I guess, if you want to find a long-term positive in some ways, and I mean positive for prices, not positive for the people that work in the industry, which is that production probably is going to go down. We are going to see the amount of growth slow down, if not contract, in the United States. OPEC, maybe this week, could take 600,000 plus more barrels off the market. If you had to look out, Mike, 2 years, a year, 3 years, do you think that there is a case to be made for oil prices?
I think there's a case to be made for higher oil prices in 21 and 22, and the reason why that is the biggest impediment to higher oil prices over the last couple of years has been U.S. production growth. At the current oil price, most companies cannot make money. You're going to see capex cuts happening. They're going to be fairly aggressive from here. And so I think most people are expecting we're going to have pretty good growth in 21. I just don't see that happening. So we're going to probably be looking at flattish growth or probably even negative growth. You know, if we have demand start to snap back to the 1.2, 1.3 normalized type growth, there's going to be some room for OPEC to take market share. That will be a lift for prices. We don't expect prices to go to 75 or 80 bucks or anything like that, but I think from where we are right now, 60 to 65, I don't think it's out of the question in 2021.
As long as demand stays there or at least rebounds. Michael Bradley at TPH. Michael, I'll miss you guys. Maybe go out and spend a little money.
Miss you
Sounds
too.
like you could use it. All right, Mike, take care. Thank you.
All right, bye.
Ahead on Power Lunch, this rally is losing some steam. We're about 300 points off the highs right now. The Dow's up less than 500. About 491. Is the Corona bottom really in? We've got those details as we watch major averages. We're back after this break.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
One mistake that many traders make is trying to pick the perfect entry price for a stock they'd like to own. Here's something to consider. Why not just buy part of the position you'd like to have? That way, if the stock goes down, you'll have an opportunity to add additional shares at a lower price and improve your overall cost basis. I'm Randy Frederick, and Schwab is the better place for traders.
Okay. Bounced the trade idea off my firm. Same old lines. I mean, show me some technical indicators, proprietary research, something.
That's why I like Schwab. They help look out for your blind spots.
Come on, Johnny, you got this, buddy. Speaking of blind spots.
It's time to trade up. Schwab helps you see the full picture with powerful intel and trading specialists who get it. Plus, get commission-free online stock, ETF, and options trades. Schwab, the better place for traders.
Did you know that you can sell your life insurance policy for cash now? Paul just sold his. Yesterday, he was struggling to pay his medical bills and life insurance premiums. Today, he's rich. You can cash out on your policy, too. If you're over 70 or have a terminal illness with over $50,000 of life insurance, chances are you can sell your policy for cash now. Call Harbor Life to get a free, no-obligation quote and see what your policy is worth. Don't cancel or let your policy lapse. Call now or visit HarborLifeSettlements.com to find out how to get the highest price for your policy.
Call 1-800-733-8314 right now, and Harbor Life will send you 2 free brochures on what insurance companies don't want you to know. Once again, the phone number is 1-800-733-8314. Call now to see if you qualify.
There's no furniture at all.
Yeah.
Len needs to understand that we have a job to sell his expensive house and not his art.
This is not a house for everybody.
Listing Impossible, all new Wednesday at a special time, 9 Eastern. CNBC, get yours.
This is Kate. Hey. She takes 2 prescriptions. Kate's son Jack takes 1 too. Kate works hard and thought she had good insurance. But she still pays too much. That's no good. So Kate downloaded the GoodRx app. Now she can compare prescription prices to find the best discounts. She even beats her insurance price. Good for you, Kate. Good for you. GoodRx. Stop paying too much for your prescriptions. Download the free app today.
I finally got to start my career. Except that I was spending thousands of dollars on interest on my student loans and I needed to refinance. And then I found Credible.com. Within just a few minutes, I had actual rates from lots of lenders. Now I'm saving thousands of dollars and I'll be out of debt much sooner. And and I can focus on my future. It was so easy, I wish I had done it years ago.
Visit Credible.com to see how much you could save on your student loans.
Welcome back. The business world lost an icon today. Jack Welch, the former chairman and CEO of General Electric, has passed away at the age of 84. He ran GE for 20 years and grew the industrial giant and conglomerate from $12 billion to over $400 billion. Back in 1999, Fortune magazine dubbed Welch the manager of the century, a man who worked for him for several decades and has known him for generations. Joins us now to remember Jack Welch's legacy. On the line is former Honeywell International chairman and CEO Larry Bossidy. Larry, what are your thoughts today?
Well, it's a sad day for me because Jack was a truly exceptional person in all dimensions. He had the courage. He was certainly competitive, had a great vision in terms of what GE could be, took some difficult actions for which he was criticized to reposition it for the decades that were to follow. And, of course, the results have been obvious, including some of the statistics that you just mentioned. I thought that the most amazing thing about him was he had the ability to see around corners. He anticipated things and allowed GE to take advantage of opportunity or prepare for some negative happenings that might occur as well. And so by virtue of that commitment and that courage, he was just a remarkable leader.
How did you guys meet each other, and what was it like knowing him over the years?
Well, we met in 1978, and I was with GE Capital at the time and a little bit tired of the GE bureaucracy and was looking about ways to leave. And we had a meeting in Hawaii. Welch had just been appointed the head of the materials sector, and he came to Hawaii. GE Capital was a part of the materials sector. He came to Hawaii. We got into a ping-pong match, and we both were falling on the ground trying to win. And I said to myself, this guy's competitive. And then at the end of the conversation, he said, look, I know your frustrations, but give me a shot, will you? And the rest is history.
Larry, it's Brian Sullivan. Can you give us another anecdote? We like the ping pong one that you just told us. Give us something else that we may not know about Mr. Welch.
I remember we were going into a significant negotiation. We had two approaches, and we were going to give the person with whom we were meeting the less desirable of the two approaches and then fall back on a better one if we couldn't sell him on the first. Well, it turns out that he gave him the better proposal first. And just as the guy was about to open up, he recognized it, pulled it from his hand, and said, oh, that's our inferior proposal. We have a better one now. And he gave him the one he should have given him at the outset, and he got away with it.
And that just goes to show, Larry, his competitive spirit, right?
NBC.
His winning. We'd love to know what deal that was in the making. What do you think when people talk about Jack's legacy? There's going to be a lot about what he'll be remembered for. What do you think is something that's misunderstood about him?
Well, first of all, he was a compassionate guy, despite this neutron Jack appellation that's been tagged with him. But also, he was fun. I mean, he celebrated, he shared praise generously with those around him, and he was just a good guy to be around, and he had a remarkable ability to rally you around whatever he wanted to achieve.
Wow,
so people enjoyed working with him. He was demanding and tough, but he was fair. He was very candid, and he changed the culture of GE by virtue of those characteristics.
Larry, thanks so much for joining us, share your recollections today.
My pleasure.
Larry Bossidy knew Jack Welch for decades. Again, we mourn his passing today. Power Lunch will be right back.
As a struggling actor, I need all the breaks that I can get. At Liberty Buchamug.
Cut.
Liberty Bibbity.
Cut. We'll dub it.
Liberty Mutual customizes your car insurance so you only pay for what you need.
Only pay for what you need.
Liberty, 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 liberty.
Apps are used everywhere except work. Why is that? Is it because people love filling out forms? Maybe they like checking with their supervisor to see how much vacation time they have. Or sending corporate their expense reports? I'll let you in on a little secret. They don't. By empowering employees to manage their own tasks, Paycom frees you to focus on the business of business. To learn more, visit Paycom.com.
The difficult part for me was starting. I've lost about 20 pounds, which blows my mind.
The psychology aspect of Noom was different than I'd ever seen before.
Noom helped me make a couple of lifestyle changes that made achieving that goal very easy. It's a whole mentality change. Now I've lost 10 pounds.
Down 22 pounds.
57 pounds. That's a lot of weight.
Just to know that you feel yourself again, it makes me so happy and proud. Visit Noom.com and change your life for good.
When you're looking to hire, you can find just the right person on Indeed. Indeed gives you tools like online skills tests, which help a candidate show they are the right hire. We'll also give you this groundhog that will come out when the right candidate appears.
Great. You got the job.
Okay, there's no groundhog, but skills tests for sure. Try skills tests free when you post your job at Indeed.com/groundhog.
Old Dominion has ranked #1 in overall performance 10 years straight. Customers trust OD for damage-free deliveries and real-time shipment visibility. Our people never stop working toward perfection. Old Dominion, helping the world keep promises.
CNBC events at work. Overwhelming responses to this exclusive in-person experience. Lead or be left out. CNBC at work. Register now at cnbcevents.com.
All right, welcome back to Power Lunch. Well, stocks, they are still well up, but they are off their major highs of the day by about 300 points. And keep in mind that if you go from the highs of a couple of weeks ago to now, the major averages are still in correction, which is down more than 10% from those highs. It is the sixth time that we've had a drop of at least 10% since the March 2009 low. And each time we have avoided a full-on bear market or a recession, and we've headed back to new highs. But given that we've got coronavirus now, is it different this time? Jeff Hirsch has a little bit more perspective on big market drops because he is the editor-in-chief of the Stock Traders Almanac. Jeff, good to see you.
Good to be with you guys. Thanks.
Love history. Maybe the only way to plan what we're going to do is what we have done, because we all make the same mistakes.
Line from the past through the present.
But can we compare this with a traditional correction, given that we've got this potential for a global pandemic, which we really haven't had since 2003?
You have to sort of combine the corrections and the pandemics. I've done some research into that. The previous pandemics, the market, most of them didn't do all that much unless there was something else going down, like 57 when we had the rate tightening, and 68 we had Vietnam. Most of those other big pandemics that some of them had, much larger impacts medically than this particular one so far. And then you've got these corrections. So you put the two together, and we're looking at the bulk of what may go down. We've probably had already. We had it down January. We crossed the December closing low. We look at the pattern that we put together with those 22 previous occurrences. Most of the sell-off and most of the market's pain has already been inflicted, though those years we've seen be a bit softer than normally. So our outlook's a bit diminished, but
I wonder about the fact that this is an election year. I mean, you might expect the market to behave in a certain way, the stimulus to be coming in some form or another anyway. And is that especially so now, would you say?
The election year with the incumbent running, good economy is very hard to beat.
Well, I don't know about the good economy part now, though.
It's definitely coming to question, but it's early. And a lot of that pent-up demand from people not doing things could, easily pop out and have a surge in growth. My look at the data of the virus, I'm no virologist, but a lot of us have been looking at something that comes out of Johns Hopkins University, this dashboard. I don't know if you guys have seen it. Pretty well-documented data set. I know that everyone's questioning the data, but the recovery rate is pushing 50%. The death rate's steady at 3.4. That's great, but I'm more concerned about the regular flu, which, is already 300,000 people have been hospitalized just in the U.S. and 18,000 people have been killed this flu season.
But from the market's point of view, you have to price in the way that people are going to react to this. I mean, when we talk about who should get on planes and what kind of travel should still happen or not happen, even if this turns out to be, from a health point of view, not as bad as feared, the market's clearly pricing in a very different economy than it had previously thought. I mean, Goldman thinks we're going to barely average 0.5% growth over the next including this one, 3/4.
I think everyone's jumping to some extremes at this point. It's early. The impact so far has not been that great globally. We've seen quietness in China. Travel is restricted. There's a lot of fear going on out there. Fear does seem to be spreading faster than the virus. And we will see how much this impacts the economy. And as I said, once things get cleared up a bit, we could have that surge in growth with all the pent-up demand.
I do, and I don't want you to get into the murky and ugly world of politics. I would never do that. But we've mentioned, people have mentioned, did the market also sort of get rattled by this Bernie Sanders boom? Now we had this big Biden win, Klobuchar out, Buttigieg out. I wonder, is there a Biden bounce as part of this?
It could very well be. I think the market was suffering from several things going on. We had general weakness in the month of February, the worst month of the best 6 months. We've had some excessive valuations, some excessive sentiment, some contentious election battles. So all that together, throw in a little, pandemic scare or a big one, and you've got the makings for a correction here, which is what we have, the 10% correction. Whether it gets further, goes further, depends upon how we deal with it on a medical CDC level in this country, and whatever happens coming out of the Fed or fiscal policy. I think any of those emergency cuts that we've seen, there's only one that really worked, was 98 when we had the long-term capital management currency crisis. Otherwise, getting into Fed moves between meetings, it just, I think, freaks people out a bit.
Interesting. So you think it would maybe harm more than help if they did the kind of extraordinary...
If they needed to do something, it would be better to do it at these regularly scheduled meetings.
All right. Jeff, we appreciate it today. Thanks for your point of view. Jeff Hirsch. For much more on this big market rally, stay tuned. We're going to take a quick break. We'll have a lot more on the Dow. 620-point gain today and where exactly the biggest gains are coming from. And don't forget, you can always watch or listen to us live on the go on the CNBC app. Be right back.
I believe ETFs are a great way to invest in the market. I just don't believe in market cap-weighted ETFs. My research shows how fundamentals can lead to performance, and that's exactly how WisdomTree builds their ETFs. To me, it's a better way to invest. Legacy ETFs that track the market? That's yesterday. Modern alpha ETFs built for performance? That's WisdomTree.
Carefully consider the fund's objectives, risks, charges, and expenses before investing. Obtain a prospectus at wisdomtree.com. Read it carefully.
People know Aflac, but not what they do. So we're answering their questions.
Aflac is auto insurance, right?
No.
Is it homeowners insurance?
No.
Is it duck insurance?
Nope.
Do they pay me money directly when I get sick or injured?
Yeah. Aflac. You got it. You know Aflac.
Boom.
Get help with expenses health insurance doesn't cover. Get to know us at Aflac.com.
Did you know a lot of medication sold online may be counterfeit? That's why we created Roman. Just visit GetRoman.com, and if treatment is right for you, you'll get genuine medication delivered to your door. Get started today at GetRoman.com/TV.
We see heating breakthroughs clearing the air for billions. At Emerson, when issues become inspiration, creating a better world isn't just a result, it's a responsibility. Emerson. Consider it solved.
She worked with Travis Bass, Ricky Williams, Lex Hilliard, and Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed tonight, 10 Eastern. CNBC. Get yours.
This is Kate.
Hey.
She takes 2 prescriptions. Kate's son Jack takes 1 too. Kate works hard and thought she had good insurance. But she still pays too much. That's no good. So Kate downloaded the GoodRx app. Now she can compare prescription prices to find the best discounts. She even beats her insurance price. Good for you, Kate. Good for you. GoodRx. Stop paying too much for your prescriptions. Download the free app today.
At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month.
Visit Credible.com to see how much you could save.
Hey, guy. ED issues? We got this. Today's your day. Go to forhims.com/ED.
All right, time now for check, please. Let's start with the markets. We're up 550 on the Dow. I think you're starting to see some notes from Matt Maley and others. Kelly, watch this 200-day moving average on the S&P 500. the number, right, whatever it is, 28, 25, whatever, if we can stick there and kind of hold and bounce up, it's a good sign. If we fail, maybe look out below. That's not my opinion, from Matt Maley and some others.
Well, psychologically, I just want to see if 3,000 holds here for the S&P. On oil, last hour, Jeff Curry of Goldman told us that he sees the WTI, if Brent goes where he thinks, kind of in the high 30s, Brian. So I do wonder if there's more downside for crude here, even though it's rebounding today. And on that note, low gas prices might help a place like Costco, one of the best performers today. We all saw the pictures about the lines and in some cases the shortages of paper goods, household goods that Costco experienced after everyone thronged the stores over the last couple
I saw
of days.
$1.77 a gallon gas from Gas Buddy in Texas. I've been kind of hunting. We use 650 gallons each, roughly a year on average, of gasoline. So do the math, you're down 50 cents. You save $325 a year. There's, I guess, some upside.
You might have to drive to Texas for that deal. Thanks for watching Power Lunch, everyone.
Closing bell begins right now.
Welcome to Closing Bell. I'm Sarah Eisen here at the New York Stock Exchange, where we are seeing a significant rally on Wall Street. Best day for the S&P in about a year. The comeback continues. All groups within the S&P are higher, except for energy just slipped into the red. Off session highs up 518 on the Dow. At one point, we were up 843 points.
Yeah, well off the highs, as Brian and Kelly were discussing. I'm Wilfred Frost. Good afternoon to you. You're looking at a live shot now of the White House, where the president is hosting a meeting with members of the coronavirus task force and pharma executives. We'll monitor that and show you any headlines as we have them. Our Eamon Javers is inside the meeting. He'll join us when he's free. Meg Terrell is monitoring from back at HQ. Meg, what can we expect to come out of this meeting?
Well, if we did see those executives head into the White House just a few minutes ago, the CEOs of GSK, Gilead, Regeneron, Moderna, Inovio, CureVac, and Novavax, as well as research chiefs from J&J, Pfizer, and Sanofi Pasteur, they're expected to discuss the status of development of both vaccines and drugs for the novel coronavirus. All of these companies have announced programs except Pfizer. Gilead and Regeneron have medicines in development, while the others are working on vaccines at a fast clip, with Moderna already having delivered a batch for human testing to the NIH. Still, timelines are long, at least a year, until any potential vaccine could be ready. Our producer, Stephanie Dew, catching up with Novavax CEO Stan Erck on his way in just now, asking what he hopes to get from this meeting.
I'm hoping to get a commitment from the government they'll do everything to accelerate the process, to help us. So that's what we're hoping for. So we'll see.
And we'll talk more about the meeting with Sanofi's head of vaccines research, Dr. John Shiver, right afterwards. Meanwhile, guys, the case numbers are continuing to rise here in the United States, with Seattle and King County just announcing an additional 4 deaths, bringing the total in this country to 6. Guys.
What are you expecting, Meg, in terms of the numbers of those that are diagnosed, given the fact that the CDC apparently is starting to provide more tests, or is it?
It is, Sarah. And in addition, we are starting to see local public health labs and hospitals and academic labs get the capacity to test using their own tests as well. So Scott Gottlieb estimates we're going to be seeing 20,000 test capacity per day within a couple weeks. Already the numbers are dramatically increasing as these local public health labs get the ability to test themselves. So huge numbers each day, and we're really trying to keep up with them, tracking them. So the numbers are going to keep rising. And we've had experts on our air today saying they think maybe hundreds, potentially thousands of cases are already circulating here. And now we're just starting to detect them.
All right, Meg, we'll get back to you in just a bit. In the meantime, big rally here on Wall Street. What's driving the action? Stocks in recovery mode after last week's record-setting losses. Apple leading the Dow up almost 6%, as one analyst says, buy into the weakness. That stock is up 6%. Investors are becoming increasingly optimistic about the chances of stimulus from the Federal Reserve and other central banks. But we did get a disappointing read on U.S. manufacturing activity. ISM index falling in February, missing expectations, though still above that 50 expansion level.
I mentioned as well those news of the extra deaths from Seattle probably had an effect on the market. We sold off in the last hour or so. We're now up less than 2% on the S&P 500. Joining us for the full first hour of the show, Oliver Perscher from 1879 Advisors, which oversees $1.6 billion in assets. Oliver, good to see you. Was this bounce today expected, and how important is it that we see it hold?
Well, it's important that we see a hold. It was expected based on a rally into the close on Friday afternoon. The VIX, when it tends to get above 40, that tends to signal a short-term bottom, and that's what we saw on Friday. It was also important that we didn't get more bad news over the weekend, because that could have certainly derailed it. The real question is what happens tomorrow, what happens Wednesday, as we start getting more data about coronavirus in the United States. Does that spook investors? Is there something else out there? You know, how we close in the next hour is going to be very important, because that's going to drive sentiment.
So you guys oversee $1.6 billion in assets.
Yep.
Mostly, what kind of clients?
So the 1879 Advisor is our retail-facing brand, so it's high net worth and mass affluent clients.
What are they doing with their money?
They're staying put. We haven't had many calls in the last week. We've had a few from the jittery clients, and it always tends to be the same people that are nervous. But generally speaking, they're staying put, they're staying invested, and we haven't seen anybody pulling assets. We also haven't had anybody kind of say, hey, I want to buy more on the dip. So sometimes you see that. We haven't seen that as of yet. Generally speaking, I would say people are staying relatively calm in terms of how they're behaving with their portfolios.
Well, it sounds like the 1879 client base are much more relaxed than the many we've spoken to. But good for you. Good for you. It's not been the phone ringing off the hook over the last week.
Meantime, companies continue to outline the virus impact and what steps they're taking in response. For instance, Target canceling its in-person investor meeting. Nike has temporarily closed its European headquarters after an employee was found to be infected with the virus. Honeywell is seeing a surge in demand for its protective face masks. Widespread reports of lines at stores like Costco this weekend. That stock up nicely. 0.25% on those reports of increased demand. And interestingly, the New York Times today warning on its revenue guidance, saying it is, quote, seeing a slowdown in advertising bookings, which we associate with uncertainty and anxiety about the virus, which could suggest it's not just airlines, cruises, and restaurants, uncertainty seeping into other parts of the economy, and certainly business spending, Oliver.
Well, we're seeing today utilities is the strongest sector, and that's fairly insulated from coronavirus. So again, I think it's way too early to call it a bottom. I think investors should continue to be cautious. That doesn't mean sell. That doesn't mean act irrationally. But certainly take your time and digest the data.
Meantime, on the economic side, some early data from China painting an ugly picture, with the Purchasing Managers Index falling to a record low of 35.7 in February. The Caixin unefficient survey came in above 40, only just. That came out this morning. Gaming revenues in Macau fell nearly 88% for the month. Italy's PMI showed the 17th consecutive monthly decline, coming in at 48.7. That survey was completed on February the 21st, though, before the worst of the outbreak hit the country. The Eurozone's overall reading was 49.2. In fact, the UK's reading slightly stronger. As for the global outlook, the OECD slashed its global growth forecast to 2.4% this year, down from 2.9%, the lowest since 2009. Evercore ISI cut its US GDP forecast to 0 for the second and third quarters in a note titled US Virus Recession. And Jan Hatzius from Goldman Sachs downgraded his global GDP outlook by around 1 percentage point to 2%, and called for the Fed to cut rates by 100 basis points by the end of the second quarter. Hatzius will join us live in a few moments' time. The thing I just point out with some of those Eurozone PMIs is that they are below 50 already. They remain below 50, and in large part not really factoring in any of the impact yet. And it just shows that lack of wiggle room that a lot of other economies will have if things continue to get worse, essentially very close to recession already.
Yeah, I mean, we haven't seen any of the data yet, the economic data, from when the worst of the virus outbreak was, and we won't for another week or two. So that's why I expect more volatility. But look, at the end of the day...
I don't understand how you can make a forecast, though, on the U.S. without even knowing what the virus is going to look like here.
Well, I think that's the problem, right? Humans are terrible at forecasting risk. And so we either exaggerate it or underplay it significantly, and that's what you're seeing. Last week was probably a display of exaggerating the risk because we don't know yet. The good news is that even if the worst case scenario from an economic perspective is correct and we get at 0% growth or even negative growth, that demand tends to get pent up and not just dissipate. Right, so you're going to make up for it for some point down the road. It's just a question of when, and that's why the markets are going to be volatile until you get some visibility there.
Let's go over to Mike Santoli for the first market dashboard of the session. Mike.
Yeah, so here's what we're going to have for you. Would you rather get your investment income from stocks or bonds? Look at the relationship between dividends and bond yields, and then anything you can do. It's the growth versus value relationship, which actually hasn't changed all that much with all the volatility. Truth or dare, this is the interplay between more secure types of debt and riskier debt, and then apples to apples. That's a look at a longer-term trend of that stock, Apple. So would you rather? So obviously bond yields have been collapsing, and right now stock dividend yields as measured by the S&P 500 are handily exceeding the level of the 10-year Treasury yield. This goes back 10 years to show this relationship. Now, what's amazing is how steady the dividend yield in the S&P has been. As the index has gone up, of course, dividends have grown, and it's really tacked right around that 2% level for the better part of a decade, and actually even if you go back farther than that. So 3 distinct episodes when we traded for a period of time below the dividend yield in terms of the bond yield. That was starting in 2011, 2016, and then now. So this clearly is not the reason market's up today, but it's part of the backdrop showing that the relationship between stock versus bond performance had become very stretched in the long term. I would say there's a little bit of a caveat here, which is if you go back to the 1950s, dividend yields were always above bond yields, and it wasn't until the late 50s that they crossed, and a lot of people thought that was upside down. So if we're in a permanently low interest rate environment, who knows if this is just going to be the new status quo. Take a look at this other chart, though, just to show how prevalent it is to have individual stocks that have dividend yields higher than the Treasury yield. Something like 360 S&P 500 stocks, which is essentially almost all the stocks that pay a dividend at all, now have a yield higher than 1.08% or so, where the 10-year Treasury yield is. So if you think you're willing to take the downside risk of equities, they're paying you a little more than the Treasury is to do it.
Mike, if we went back to the first chart as well, those two previous instances, they prolonged and lasted for quite some time, though, as well.
They did. They persisted that way for a good while. Now, they were also times when you had a very strong period of stock performance begin. Once you got to the lows in stocks in 2011 and 12, they obviously did very well, and then 2016 too. So it is a little bit of an oscillator that shows you when one market has had its run and the other one might be due.
Okay, Mike, thanks so much. We'll see you again shortly. Still ahead here on the Closing Bell, focus on the Fed. Former Fed Governor Sarah Bloom Raskin says pandemics don't care if you cut interest rates. We'll get her thoughts on the global central bank response and what, if anything, can be done.
After the break, Larry Cantor from Atlas Merchant Capital has a message for investors with cash on the sidelines. He'll be here to share it with us next. Dow's up almost 700 points, now 700. We'll be right back.
Turn on my TV and boom, it's got all my favorite shows right there. I wish my trading platform worked like that.
Well, have you tried Thinkorswim? This is totally customizable, so you focus only on what you want.
Okay, it's got screeners and watch lists.
You can even see how your predictions might affect the value of the stocks you're interested in.
Now, this is what I'm talking about.
Yeah, it'll free up more time for your true crime shows.
British baking competitions.
Didn't beg you for a crumpet guy.
Focus on what matters to you with Thinkorswim.
Alexa, tell me about Neptune's Sorrow.
It's a masterstroke of heartache
And redemption.
The Lexus NX, modern utility for modern obstacles.
Lease the 2020 NX 300 for $359 a month for 36 months.
Experience amazing at your Lexus dealer.
Grubhub and No Kid Hungry are feeding the 1 in 7 kids who live with hunger. Join us, round up your change, and donate with every Grubhub order. Order and donate today.
Dana-Farber Cancer Institute
discovered the PD-L1 pathway.
PD-L1.
They change how the war fights cancer.
Blocking the PD-L1 protein
lets the immune system attack cancer.
PD-L1 transformed.
Revolutionize.
Immunotherapy.
PD-L1 saved my life. Saved my life.
Saved my life.
What we do here at Dana-Farber changes lives.
Everywhere.
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 She worked with Travis Bass, Ricky Williams, that's Hilliard, and Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed tonight, 10 Eastern. CNBC. Get yours.
You went to college. You're smart. So why are you getting ripped off on your student loans? At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month by refinancing to a lower rate. Don't get ripped off on your student loans. Let's focus on your future, not your debt.
Visit Credible.com and in 3 minutes, see how much you could save.
These folks, they don't have time to go to the post office. They have businesses to grow, customers to care for, lives to get home to. They use Stamps.com. Print discounted postage for any letter, any package, anytime, right from your computer. All the amazing services of the post office, only cheaper. Get our special TV offer, a 4-week trial plus postage and a digital scale. Go to Stamps.com/try and never go to the post office again.
Welcome back. There is a chart of the euro over just the last week. A huge surge, 2.8% in the last week. If you extend it by further couple of trading days, close to 4% from below 108. Today flirting with 112. And Sarah, we were discussing this a bit earlier. Even if the outlook for growth remains much better in the US, the capacity for rate cuts here much higher. And I think that's really what's driven this in the last couple of days.
Yeah, expectation that the Fed goes more aggressively, and also just the unwind of that strong dollar trade, which has built up so much. Last week, the Dow dropped more than 3,500 points, worst week since the financial crisis. However, markets are bouncing back today on expectations that the Fed will likely cut rates at its next meeting. That is on March 18th. Circle your calendars. But is it enough to temper the economic impact of the coronavirus? Joining us is Larry Cantor. He's the operating partner at Atlas Merchant Capital. He's also on the investment committee at Betterment, an online wealth management company. So, Larry, can the Fed do anything about this?
Well, that's not the main thing that's going to help here. We don't know at this point the severity or the spread of the crisis, and that's what's really going to cause markets to bounce, not the Fed. Fed probably helps, especially with getting the dollar down. We've already seen a massive rally in bond yields. So if anything, a Fed cut, which I think is likely in the next couple of weeks, if we're in the same situation when they meet next. But that's not really going to turn things around. It's really going to just confirm what's happened.
So what do you make, Larry, of the scale of the equity market sell-off we saw last week and this initial bounce today? Do you think the bounce holds?
No. I mean, first of all, we have not seen the economic damage yet, as somebody mentioned before on your show. And it's going to be significant. I mean, it's coming from both the supply side in terms of, supply disruptions from the likes of China, and the demand side. Who's going to go on a cruise today? So it's going to be pretty significant. So what I would say is this for the average investor: don't panic. Investors tend to sell after things plunge and go down, and then buy after they rebound and go high. So they end up, selling low and buying high. Stay in there, basically, because even though we don't know the severity of this or the spread, it will be contained at some point. The economy will bounce back. You can feel pretty confident that before the end of the year, even if it lasts a long time, like 6 months, stock prices are going to be higher than they are now, and so are bond yields. So stick with it, is what I would say, and stay calm. Again, we haven't seen the damage yet. I don't know, you've been saying the rally today is because of Fed expectations. I think that's been there for a while. We had a very severe drop last week of some stocks that people like are now pretty attractively valued. And I think you're probably seeing some people edge in a little bit here. But if it were me, I'd probably expect more declines going forward.
But you tell people not to panic, Larry, and I guess the idea is you have to think about the time frame here. With that in mind, what are you looking at? Because I was speaking with someone who, is going to be retiring soon and says, I can't go through another financial crisis like we had because I'm so close to retirement. So what do you tell someone like that?
Well, if you're a year or two from retirement, you shouldn't have been overloaded in stocks in the first place. Stocks, as you know, we have corrections. We had a very long period where things were just going up. We're probably going to get a correction anyway, not this severe. But I would still say hold steady because things will improve. Again, we don't know how long this is going to take, but it would be shocking if this isn't contained, say, before year end. I mean, that's I would say the longest that time horizon you'd be thinking about. So, again, my view is stick with what you've got. If you have excess cash, you might want to start looking at least edging into some stocks that look very attractively valued, but be prepared for further declines. That's what I would say. Now, what should we be looking for is the question?
Larry, as for stocks that might be attractively valued, I wanted to ask you about U.S. banks, of course, a sector you know a huge amount about. They fell into bear market territory, down 20% from their January highs. Does that make sense to you, given the move we've seen in yields, or are those very attractively valued?
I think that's one of the sectors you could think about edging into. But again, any amount of money you put in there, be prepared that things could even get worse, because we still haven't seen the economic damage. But in terms of asking the question, what should you look for? Markets will rebound before the economy does. And what the markets are going to be looking for is a peak in the growth in the spread, okay? So some indication, light at the end of the tunnel, that they're getting this thing under control. When you start seeing a sign, and by the way, there are signs already within China, although they took draconian measures to prevent the spread, that the incidence is slowing. We are not at that stage in the United States and most other countries yet, where actually the spread is accelerating. So that's what you want to look for when to see the markets bounce, and we are not there yet.
Larry Cantor, thank you.
My pleasure.
We've got 40 minutes left in the trading session. Dow's up more than 700 points. S&P also having a nice strong bounce, best day in a year. Almost 3% gain there in the Dow. 11 sectors higher. Healthcare is actually leading, along with real estate, technology. Some nice 1 to 2% gains across the board. Up next, a number of firms out with a buy list as stocks remain well below record levels. I'll tell you some of the surprising names that made the cut.
And we'll continue to bring you the headlines from the White House coronavirus meeting with pharma executives. That's happening right now. And we'll speak with someone in the room after the meeting concludes. Sanofi's head of vaccine research, John Shiver. Stay with us. We're back in a couple minutes.
So Schwab taught me about four-legged option strategies. I'm going to go with an iron butterfly spread on the fintech stock.
Nice. I just tried an iron condor.
Only spread I've been introduced to is this onion chive.
It's time to trade up to Schwab, the firm invested in helping you become a better trader. Get commission-free online stock, ETF, and options trades. Expect more from your firm. Schwab, the better place for traders.
Welcome to the place where people go to learn about their Medicare options before they're on Medicare.
Come on in. You're turning 65 soon?
Yeah.
And you're retiring at 67?
That's the plan. It's also a great time to learn about an AARP Medicare Supplement Insurance Plan insured by United Healthcare Insurance Company. Here's why. Medicare Part B doesn't pay for everything.
This part is up to you.
A Medicare Supplement Plan helps pay for some of what Medicare doesn't. Call United Healthcare Insurance Company today to request this free decision guide and learn about the only Medicare supplement plans endorsed by AARP, selected for meeting their high standards of quality and service. This type of plan lets you say yes to any doctor or hospital that accepts Medicare patients.
Do you accept Medicare patients? I sure do.
So call United Healthcare today and ask for your free decision guide.
Oh, and happy birthday or retirement in advance.
Guys, if you wake up feeling fat, bad back, heartburn, tired, then it's time to get healthy and lose weight with Nutrisystem for Men.
I'm healthier, I'm stronger.
Lose up to 13 pounds and 7 inches overall in your first month. Money back guaranteed. Order now and we'll rush you Nutrisystem for Men.
Not only did I lose 60 pounds, I don't snore.
Act now. Buy 1 month, get 1 free.
Go online or call 877-344-FIT5 right now. Buy 1 month, get 1 free.
Next on Squawk Box, coronavirus fears, market volatility, dilemmas for investors. Should you buy, sell, or sit tight? Some strategies to get you through the turmoil. Squawk Box tomorrow, 6 a.m. Eastern. Watch and listen live on the CNBC app.
Wondering which credit card is right for you? Introducing CNBC Select, the authority on all things credit cards. We do the research, you reap the rewards. Head on over to cnbc.com/select and take control of your money.
Welcome back to Closing Bell. Time now to get word on the street. Multiple Wall Street strategists saying now is the time to buy. Bank of America Global Research's strategy is looking at companies whose outlook does not materially rely on China, demand is not overly discretionary, and whose valuations have fallen well below average. They've come out with 55 names on that list, among them Netflix, Target, Exxon, P&G, and Nvidia. Some of those, all of those, they're trading higher today. I should say, not necessarily saying the whole market is now the time to buy, but for those stocks on their conviction list, they are. Baird says it's repositioning for shock and has identified names with resilient business models, defensible balance sheets, and limited exposure to Asian supply chain risks. Those include Chipotle, EOG Resources, Capital One, Alexion Pharmaceuticals, and Facebook.
Many of those down today. Wedbush Securities out with its playbook for tech investors on navigating the coronavirus sell-off, saying now represents what they call a golden opportunity to own tech themes. Among the top names on that list, Microsoft, Apple, Tesla, Adobe, and Zscaler. Among those, Apple seeing a big surge. So is Tesla, up 9%. Do you have a good opportunity here on this shopping list?
Yeah, I mean, we like Apple. We like several of those names. I would say this. There's been a lot of talk about the pharmaceutical sector, and obviously we're all talking about finding a cure, finding a vaccine, finding something. I would be very cautious on the pharmaceutical sector. Yes, it's likely to continue to see a short-term bounce, but to us, there's an enormous amount of regulatory risk built into the pharmaceutical industry. We know this much. We know that either President Trump is going to win the election or a Democrat is going to win the election. Those are the two choices.
Right, but do you really think they can keep up campaigning, especially the Democrats pounding the drug companies and the healthcare companies, when we need their ingenuity now more than ever?
You're 100% correct. However, President Trump has already stated that he wants policies that are not particularly friendly to the pharmaceutical company, transparent pricing, lower drug pricing. So I'm saying that either, depending on which party, it doesn't matter which party wins, either one have a regulatory risk. And so I would be very cautious to jump too aggressively into pharmaceuticals here.
The thing that stood out to me from the Bank of America list is 55 stocks, I mean, literally from all of the sectors. Yep. So focusing on the very much stock specific. So is it too hard at this stage to pick out a sector that's going to benefit or a sector that's going to suffer? Well, do you have to be stock specific?
You should be stock specific always. And what we look for specifically is we want robust balance sheets. We want growth outlook, ideally meaning that the company is taking market share from their competitors. And we want earnings visibility, meaning that we can see what is happening and can look past 2-3 quarters of how the business model is going to evolve. And if at all possible, if that can include what we like to call compounders, meaning that in addition to the revenue growth and to the earnings growth, they're buying back shares or raising dividends, and that's sustainable because of the strong balance sheet, then we feel pretty good about the long-term prospects of that stock.
Okay, there we go. At the moment, we are up about 2.5% on the NASDAQ, as you can see, climbing back towards the session highs. The Dow's up 824 points. The high was 844. So that brief little sell-off we had early afternoon.
Still 34 minutes
in the
left
rear
to
view
trade.
mirror. Yeah, exactly.
Anything can happen.
Coming up, tech investor Dan Niles will be today's closing bell closer. He'll tell us the moves he's making in his portfolio, including his thoughts on Apple amid the volatility.
After the break, Goldman Sachs chief economist Jan Hatzius predicting the Fed will cut interest rates 100 basis points by the end of the second quarter. We'll break down that big call next. And as we had to break a check on bonds for you. Treasury yields falling again today. The 10-year yield hitting a record low of 1.03%. We're well above that now at 1.10%, but still there's buying of treasuries, and that's pushing yields lower. We'll be right back.
The Bond Report is sponsored by PIMCO.
If something happened to you, what would happen to them? Their home, their education, their future. You need life insurance, and chances are SelectQuote can help you get it for less than $1 a day.
SelectQuote found Jacob 40, a $500,000 policy for only $19 a month. And SelectQuote found his wife Wendy a $500,000 policy for only $17 a month.
Our secret? At SelectQuote, we aggressively comparison shop highly rated companies to find you the company with the best rates.
We found Gary, 35, a $1 million policy for only $22 a month.
Why pay more? Give your family the security they need at a price you can afford.
Call 1-800-515-1155 or go to selectquote.com now and get the insurance your family needs.
At a price you can afford. SelectQuote. We shop, you save.
My reputation was trashed online. I felt completely helpless. My entire career and business were in jeopardy. I called Reputation Defender.
Take control of your online reputation. Get your free reputation report card at reputationdefender.com. Find out your online reputation today and let the experts help you repair it. 8555.
The biggest day of the race so far. Breaking down the results of Super Tuesday. All-day coverage tomorrow on MSNBC.
Hi, Linda. Looks like you've got a prescription to fill. Any idea how much that's going to cost in there? The exact same drug that's $10 at this pharmacy is $150 at this one. GoodRx finds prices and discount coupons on every prescription. Just input the drug name and instantly find savings at virtually every pharmacy in America.
Next. What can I do for you? Here's my prescription, and I have a coupon from GoodRx. Nice price.
Stop paying too much for your prescriptions with GoodRx.
I got things I want to do, but student loans were holding me back. Credible.com helped me save $600 a month with a great rate. Now I can go do what I want to do.
Visit credible.com to see how much you could save on your student loans.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or so convenient. Get your first month free at trykiwico.com.
Welcome back to Closing Bell. We are looking at a very strong bounce here, coming back off the worst week since the financial crisis for stocks today. The Dow's up 3.25%. We've got every group higher in the S&P 500. We're back above 3,000 on the S&P, back above 26,000 on the Dow. Utilities are leading the charge right now at 4.3%. Staples also rallying nicely. So it's still a defensive tilt as yields move lower, but a pretty broad-based buying attempt today.
Certainly.
After a lot of selling.
And here are the key things driving the action so far. Stocks in recovery mode after last week's record-setting losses. Apple leading the Dow, almost 7% higher for that stock. Investors are also becoming increasingly optimistic about the chances of stimulus from the Fed and other central banks. But we did get a disappointing read on U.S. manufacturing activity as the ISM index fell in February, missing expectations. Time for a CNBC News Update with Sue Herrera. Hi, Sue.
Hello, Wilf. Hello, everybody. Here's what's happening at this hour. Joe Biden picking up two major endorsements from candidates who have ended their campaigns. Amy Klobuchar and Pete Buttigieg both pledging support for Biden's campaign to become president. Klobuchar is set to join Biden at a rally in Dallas tonight. San Antonio's mayor voicing anger towards the CDC after a woman who had visited Wuhan, China, was released from quarantine. She tested negative for coronavirus twice, but a third test came back, quote, weakly positive after she was released.
I find it totally unacceptable that CDC would release a patient prior to receiving all test results and potentially expose the public to this harm. We simply cannot have a screw-up like this from our federal partners.
And check out this emergency landing near Phoenix, Arizona. The plane, missing a tire and landing gear, touching down smoothly on its belly. Emergency crews waiting for the plane nearby. The pilot and the passenger both got out of that plane safely once it skidded to a stop. I would have been out of there a lot quicker than that, but at least they got out and nobody was hurt. I would have been out of there in a millisecond. A happy ending.
They made it look quite easy.
Yes, they did, didn't they? Yeah. Back to you, guys.
Sue, thank you.
All right, we'll go back to Mike Santoli now for the market dashboard. Mike.
Hey, Sarah. Yeah, anything you can do, I can do better. That's what growth stocks effectively are saying
into value. Even with this turmoil in the market, you had a lot of strategies upended, but growth versus value, really the same story we've seen for a while. So this is the ratio of the Russell 1000 growth versus Russell 1000 value over the last year. We did see a bit of a gut check, right? Very crowded, large cap, mega cap tech names. And that February 19th top, they did correct pretty sharply relative to value. But guess what? Back at an all-time high right here. So it's the same character of a market that we've had so far anyway for a while. Yes, some of the most beaten up value and cyclical type names are bouncing hard. But in general, with yields down where they are, people still gravitate toward traditional growth or the sort of secular growth themes right now. It also kind of means the popular trade, let's say you were long quality and growth and short cyclical and structurally challenged value stocks, it still works. So maybe the amount of pain in the professional money management community has not been that great in the sort of long, short hedge fund world as opposed to systematic traders who are just playing pure momentum and low volatility.
Okay, Mike, thanks so much for that. We'll check in again a bit later. Now, Goldman Sachs updating its global monetary policy forecast. The firm now believes the Fed will get more aggressive in face of the coronavirus. Goldman expects the Fed to announce a 50 basis point cut at its March meeting and a total of 100 basis points of cuts this year. Their chief economist, Jan Hatzius, joins us now. Jan, good to see you. Thanks for joining us.
Nice to be here.
Before we get to the Fed expectation, what's your latest GDP forecast for globally and the US?
For the world, we took it down to about 2% in 2020, with most of the weakness concentrated early in the year, Q1 and Q2. That had been a little over 3%, so that's a pretty meaningful downgrade. Partly China, but also partly the spreading virus and spillovers from China. In the US, we're at 1.3% now for this year. That's down from a little over 2%. Also meaningful.
And with the US, if we focus in on that, if the Fed does act as you expect, 50 basis points cut fairly soon, does that offset any of that, or is that growth forecast factoring in already those cuts?
It is factoring that in. So if we didn't have the ability to respond, or the policymakers didn't have the ability to respond, then the numbers would be weaker. So we do expect some support from monetary policy.
So a lot of talk about a supply shock and what's going on with China and the fact that it's been so hard. What about on the demand side? What are you anticipating in terms of an economic hit from demand in the U.S.?
Well, I would call it a risk aversion shock potentially. So we are building in some pullback in consumer categories that involve a lot of face-to-face interaction. As we see more cases of coronavirus in the United States, obviously all highly uncertain. A lot of it depends really on the epidemiology as opposed to the economics. But then there's also the question of how do consumers respond to reports of increasing cases. But I think that would be a demand shock and really a risk aversion shock, not in the market sense necessarily so much, but in terms of how consumers behave.
What's your assessment of Eurozone growth and the ability for the ECB to do anything there?
We think Europe is also taking a hit, and of course they have seen more cases, so that hit is probably actually, if anything, somewhat bigger. So Eurozone growth, we think, maybe a quarter point to a half point this year. That number was 1% or a little bit above, so we've taken it down to very close to zero. We have the ECB responding, but only with a 10 basis point rate cut. They're already at minus 50 basis points, so they can only sort of inch their way forward. And so we think the response isn't going to be nearly as aggressive as in the U.S.
So there's a G7 finance ministers call that maybe gave the market some hope and optimism today. Clearly, central bankers are getting ready. That unusual statement from Powell. I guess one question is, does any of this matter when what we really need to hear is news about a vaccine or news about a treatment or some sort of good news on the trajectory of the virus?
Yeah, there's no question that what happens with the virus and what happens with the public health response and maybe even what happens with the fiscal policy response is more important than central banks. Central banks can focus on, the things that they can control, but they're not going to be as central in this kind of situation as they were in the financial crisis, for example. As you say, there is a call scheduled for G7 finance ministers and central bank governors, and I think there is a reasonable chance that we're going to see a coordinated move maybe even sometime this
we're all going to provide liquidity and swap lines and all that
cut
stuff?
rates. And I mean, we are forecasting 9 of the 10 G10 central banks cutting rates. The Bank of Japan is the only exception. So we think they're all, or almost all, already going to do it. So it seems almost like a freebie to get a little bit of additional signal from doing it together.
Just want to point out our session high is up 920 points on the Dow. Jan, what's the bear case, though? What percentage chance do you put on China's growth, for example, being so much lower than people are currently pricing in, such that it really drags down the rest of the world?
Well, I think the alternative scenario, the main alternative scenario, is a recession. We, think that the global economy is going to contract for a quarter or so. That doesn't quite rise to the criterion of a recession in our base case, but it's not too far away. We wouldn't have to see that much more weakness, whether it's out of China and then the spillovers associated with that, or the maybe pullback in consumer activity to turn it into a recession. Our best guess is that it stops just short of that, but clearly there's a lot of uncertainty, and a lot of the uncertainty is in areas that normally economic forecasters don't have to have a judgment on, namely the medical issues.
Very quickly, there's some talk that the Fed could come out before the March meeting in a few weeks, an emergency rate cut. How high is the bar for that?
I think it's basically, if you get a coordinated move, then it would probably be quite soon. If it's every central bank by itself, then I think they would probably wait until the meeting. But, we're going to have to see in the remainder of this week whether this is something that they decide to do.
Jan Hatzius, thanks for joining us.
Thank you.
Of Goldman. We are just about 20 minutes left until the closing bell. Here's where we stand in the market. Session highs, as Wilfred said, now up nicely over 900 points in the Dow, 962. S&P bouncing 3%. The Nasdaq up 3% as well. So building strength into the close. Not what we saw last week, except for on Friday. Up next, we've got your last chance trade featuring one stock that's holding up better than the broader market over the past week.
Plus, famed tech investor Dan Niles is our closer today. Find out which stocks he bought amid the sell-off coming up later in the show.
You should be mad that this is your daily commute. You should be mad at people who forget they're in public. And you should be mad at simple things that are unnecessarily complicated. But you're not mad, because you're trading with E-Trade, which isn't complicated. Their app makes trading quick and simple, so you can strike when the time is right. Don't get mad. Get E-Trade and start trading today.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Feeling sluggish or weighed down can be a sign your digestive system isn't working at its best. Taking Metamucil every day can help. Its psyllium fiber forms a gel that traps and removes the waste that weighs you down. It also helps lower cholesterol and slows sugar absorption, promoting healthy blood sugar levels. So start feeling lighter and more energetic by taking Metamucil every day.
Take the Metamucil 2-week challenge. Lighten up. Just take Metamucil every day for 2 weeks. Available at your local retailer.
When you need hot or cold therapy for strained or injured muscles, don't give up your freedom to get your therapy. Get that healing feeling with CopperFit Mobile Rapid Relief Wraps. Hot or cold therapy wraps that strap in place and stay in place so you can do what you want while getting the therapy you need.
This is the best solution for icing and heating that I've ever found.
Get that healing feeling with CopperFit Rapid Relief Wraps. Find the entire line of CopperFit Rapid Relief Mobile Wraps now in Walmart Pharmacy.
The Barkins are empty nesters now. Should they downsize? Probably. Will they? Not as long as Thanksgiving is a holiday. Planning for the future is about more than just money. Let Equitable be your guide.
Read. Read yourself past the millions and millions of stories uploaded each day, past the endless memes, past all the social media that's making your head feel like. Read yourself better.
Welcome back. We've got just 17 minutes left of the session. We are at session highs, up 990 points on the Dow. Could well be a 1,000-point day again, but of course, moving in the opposite direction to what we've seen for much of the last couple of weeks. There is the closing bell big board. The major averages, as we've already said, are nicely higher. That's having a look at the leaders on the Dow. Walmart, Apple, United Health surging 6 to 7% each, though each of those stocks still down year to date. Huge gains today, but of course, huge losses over the last week before that. And some other names there, P&G, Visa, Verizon, to name but a few.
As we've seen this momentum build into the close, all 30 Dow stocks are now higher, with the Dow up almost 1,000 points. Oliver, our last chance trade, what is it?
Amazon. We think Amazon is an absolute category killer. They've done great in terms of taking business away from brick and mortar retail. But what's really impressive about them is AWS, Amazon Web Services. They have a relatively small market share, and we all know that Jeff Bezos is the champion at taking market share from competitors. So we think that's a stock that's going to perform very, very well, and we've certainly seen that on a relative basis over the last couple of weeks.
Albeit, of course, last year it was a bit behind some of the other big tech names, which is probably one of the reasons it didn't sell off so much.
Are you getting enough of an opportunity? I mean, did it sell off as hard as...
Well, again, we're not talking about stagnant capital, right? Money moves, money comes in, new clients have more money. So, and it's also about rotation. But again, in the context of a broader portfolio, if I had to pick one name, Amazon is it.
We've got just over 15 minutes left of the trading day. We're now in the closing bell market zone, commercial-free coverage of all of the action heading into the close.
CNBC senior markets commentator Mike Santulli here to break down these crucial moments of the trading day. And today we've got Oliver Persha still here from 1879 Advisors as well.
Mike, let's kick things off with the broader markets before we go into some sector specifics. Session highs at the close. Yeah. Talk us through what the key things you're looking out for.
Obviously, we were just absolutely spring-loaded, deeply depressed and oversold coming into it, and we've gotten, I think, more of a rally than you might have expected. The last little kick came, let's say, starting about an hour ago when bond yields finally lifted 107 up to 112. It seems like a massive rotation trade. So I do think that right now it's the strength and velocity of a rally that you would see after the kind of nasty week we had and the overshoot that we had. It's right up to the 200-day average on the S&P. It's going to give us something to talk about tonight and debate whether this was some kind of genuine, very powerful reversal. I mean, it's very plausible it was.
Above the 200-day moving average now, right?
Well, by like a point.
We'll
I mean,
watch
it's not
to see if it
relevant.
can close there.
It's not relevant. I mean, it's relevant potentially, but like whether it's a point or two doesn't matter.
Mike, just want to come back to your point on bond yields, because we've talked about that throughout the last week. When yields are still falling, it suggests people are still concerned, and therefore equities could well follow suit. Yes, we bounced off the intraday low, but it still looks like the 10-year will close lower, another closing low. So what do you make of that kind of seesaw?
I think the momentum in bonds versus stocks is so stretched in opposite directions right now that I feel like the market is willing to say, one, these very low bond yields are telling us about Fed capitulation, and we're just going to get something on the Fed side. And two, it's just that they were just so out of whack at this point. And you know, maybe they're trying to sniff out a low. I don't want to pretend I understand every relationship between every basis point and every point on the S&P, but that to me is what seems like has been going on. And it's also bullish potentially if stocks were able to ignore the decline in yields. By the way, this has mostly been an equity event. Yes, Treasury yields let us down, but equities is where all the anxiety was built up, not credit.
And there's the up 1,000 on the Dow, under 15 minutes left of trade. And it's really hard, Oliver. We can debate whether this is indeed a real bottom or this is some technical action, because you do have more talk about global coordinated action from finance ministers and central bankers. You've got a more robust response from policymakers like President Trump. We heard from him over the weekend. I mean, the market was clearly craving some leadership here, but the question is, are the virus concerns?
So our view in the short term is nobody knows. Right? I know that that's not what you want to hear, but the reality is that information continues to come in so fast and changing. And we know that the reporting on coronavirus in the United States is just beginning. So we're going to get more cases. So you're probably seeing a combination of a relief rally because of the sharp sell-off from last week. As you mentioned, the Fed expectation of lowering rates, whether it's at their meeting or before, as Jan talked about. And the question is, what do tomorrow morning's headlines, look like? As we talked about before the show, if all of a sudden there's 250 new reported cases, you might see a sell-off again tomorrow. Mm-hmm. It's not something that investors should be panicked about, though. I think it's very important to stay calm and be patient.
One sector which has rallied today and rallied hard in the last hour, as Mike mentioned, since bond yields picked up, are banks. The market, of course, higher, Treasury yields lower, the record low on the 10-year earlier in the session. We also got a specific upgrade from Piper Jaffray on JP Morgan. If we just look at the KBW Banks Index intraday, you'll see those moves kind of tracking that 10-year yield move, or the JP Morgan, as you can see, picking up at the end of the day. Just two other kind of points I'll mention. Bank of America was actually negative throughout most of the session until right at the end of the day. Again, that has been the biggest sufferer of the big cap banks amid this recent sell-off, largely because it's seen as the most interest rate sensitive. The other one I'd focus in on as well, Morgan Stanley, which from its recent high remains down just more than 20%. And again, they've announced an acquisition, not ideal time, of course, to be doing that, and had been the best performer coming into this. But either way, interest rate sensitivity, Mike, will still be a way that these banks have shown that they trade, and that pickup in yields in the last hour has certainly helped these stocks.
Without a doubt. And obviously they repeatedly get cheap again whenever yields go against them. And I think that story, once yields stabilize, the story comes back as capital return. The economy looks like it's okay. Consumers cushioned, all those things. So I do think it makes sense that they would find some footing right here. Doubtful that they're going to be, what leads us out of this thing, but certainly could participate.
The group is almost 12% off of its highs.
We're generally speaking not favoring financials, but if I had to make a bet in the financial space, I would go with regional banks as opposed to the very, very large banks, because there's still some opportunity of consolidation in that space, and they're going to be a little bit more insulated from some of the big moves that are associated from the big banks.
But also vulnerable if we do tip into a worse economic position in this country.
Yes, absolutely. But we think our base case is that we avoid recession in the U.S.
All right. Airline stocks not seeing much relief in today's session after a brutal sell-off last week. Phil LeBeau has more from Chicago. Phil.
And Sarah, that sell-off continues for most airline stocks. There are a few that have managed to get back in the green today, but the concern is that we're not sure what the demand picture looks like in the future when you look at not only international but domestic trips. So you've got demand dropping. We know that corporate trips are down, and we've heard it from companies. We also know there are a ton of anecdotal stories of people saying, you know what, my company said you're not going on the road for the next couple of months. That brings up the question, spring and summer travel demand. The leisure side of the business, will it also be under pressure? That's why you see shares of American continue to moving lower. American came out over the weekend. They said, you know what, we're going to waive change and cancellation fees for new tickets bought by March 16th. That's one step towards trying to convince the public you can book your trip. You can go. If you still have concerns, we won't make you pay a price to change that ticket. The one piece of good news for the airlines, it's the Gulf Coast jet fuel prices. They continue to move lower. They are at about a 2-year low right now. That's a lone bright spot in an otherwise really rough picture right now for the airlines, guys, as people continue to say, where will the demand be when it all settles out over the next several weeks and months?
Phil, thank you very much for that. And Mike, amazing to see when everything else, all the other sectors are higher. And we're session highs now at 1,121 points.
Which is the biggest
on
point
the
move
Dow.
ever, actually.
Biggest point move to the upside. These airline stocks suffering, again, having already fallen more than any other sector.
Right. Well, it does show you that the market is responding to some actual fundamental signals right now, as opposed to just buying everything. So it is remarkable. I do think that you're seeing, as I keep saying, the operating leverage of this industry work in reverse as the top line goes down. And it seems like, at least, even if nothing really flares up in terms of, cases of the virus accelerating from here, every company is just going to be taking these precautions, and it's going to have, you're going to have this kind of lost couple of quarters.
But your point about fundamentals is important. Live Nation is down 5% right now. I mean, they do concerts.
Right, the market's still trying to punish what deserves to be punished.
It's not an unrealistic necessarily kind of buy everything that would be down, right?
mean, this is a massive rotational squeeze going on, and it just shows you, it really is just a mirror image of what we saw last week. So unprecedented, literally unprecedented, 3% down days, 1,000 point days, I think, on the Dow. And so now you have the balloon was kind of let loose, and it's kind of popped up out of the water right now.
We are at session highs, 4.5% of gains on the Dow, 1,130 points, a record points gain as we stand. General Electric stock getting a boost today from longtime bear. JP Morgan Stephen Tusa upgraded the stock to neutral, admitting free cash flow is better than expected. Here is Tusa on CNBC earlier, weighing in on whether he believes CEO Larry Culp is turning the company around faster than expected.
If you define a turnaround by, generating $2 billion and more in free cash flow than expected, yes, he is. If you look at the underlying trend on fundamentals, which is more defined by kind of the P&L and earnings, I'd say things are stable, certainly not inflecting to the upside.
I guess commentary there, Mike, was obviously optimistic in the upgrade, but not as optimistic as people maybe had thought it was going to be from the long-time bear turning positive.
Yeah, exactly. It was a little more of an accommodation of where the stock has gotten to. There's going to be progress. It's very difficult, I think, right now. It's not something that screams cheap, even at these prices. So it is difficult.
Well, and it's up a lot less than the market as a whole. So,
today, yeah.
I mean, rising tide does lift all ships. It's not universally
You're
true.
not convinced on this turnaround?
No, we're not. No, we don't own GE and have no plans on owning it. We think that the balance sheet has a long way to go before it's something that we would get comfortable with.
So just if you're keeping score at home, remember that correction that the market was in, 10% off the highs? We're a little bit under that on the NASDAQ and the S&P. That Dow's still about 10% off the highs, just in terms of the terminology there, Mike?
Well, you're still in a correction until you get back to the highs. Okay. Once you're in a correction until you recover.
10% lower from the highs.
So we can just say that that we are within 10% of the old highs. Yes. Exactly.
Joining us now is Peter Cecchini, Global Chief Market Strategist at Cantor Fitzgerald, to discuss this massive rally, Peter, we're seeing up almost 1,200 points on the Dow.
1,200 now.
Are you guys buying?
No, look, it's one of those things we actually called for it in our note of last week, where we expected a bounce off the recent lows. This is part and parcel of what happens in much more volatile markets. I don't think you can make much of the bounce, and as you guys well know, I've been a skeptic of the rally for some time, and I think the correction, of course, was catalyzed by Corona. But it could have been just about anything, in my view, with risk-reward asymmetry so unfavorable to equities. So we're going to get bounces in here, and our view would be to sell at around 3,200.
But hasn't your view largely been based around the fact that central bankers are sort of out of the game, and that a lot of the rally was due to that? I mean, it sounds like they're coming back in. Jan Hatzius of Goldman just told us 9 out of 10 major central banks are going to cut interest rates.
Right. No, it hasn't been that they're going to be out of the game. It's been more that what they have left won't be efficacious relative to the global economic backdrop right now. So our view was global slowdown and central banks would be less effective. And importantly, I think central bank policy is really ineffective in helping to prevent the effects of supply side shocks. It's fine when it comes to creating demand, but when it comes to these sorts of shocks the coronavirus has created, it's much more difficult for them to act and counteract them.
Mike, as we watch going into the close, I mean, clearly session highs up a massive 1,200 points. What are the key things to watch out for in terms of those bond yields? They're now up on the day. Yeah. We've got the VIX down pretty significantly. Are those constructive that this is the start of something more?
They're certainly constructive. It's telling you that the stress level that had built up in the market has been relieved to a large degree. I don't think in general terms you want to be having a lot of faith or really making declarative comments about where a market's going that can spring 1,200 points in a day. I mean, not that you say it's automatically suspect, but it shows you this is still a very agitated state of affairs with this market, and we're taking back in a huge bite what we lost last week. It's not unusual for the market to kind of rally back up to half of what it lost. It's just we lost so much in such a short period of time that rally seems very intense.
Yeah, I mean, it happens. It can happen on both ways. Yeah. Peter, just as long as we're talking about the fundamentals, We talked central banks. What about the fact that Biden had such a big win in South Carolina over the weekend and two other sort of more moderate Democratic candidates stepped out and are going to likely endorse him here? Is that playing in, do you think?
Are we sure we want to talk about the fundamentals? It's a market sort of bereft of fundamentals at this point. But yeah, look, I think the election adds another layer of complication here. And, you know, at the end of the day, you can see the coalescence around Vice President Biden, as I believe the Democrats feel that their chances of victory are highest with him, certainly rather than Bernie Sanders. You know, this is a very hard thing to talk about relative to markets, especially with all these other factors at play. You can clearly see it. It's interesting, though. If you look at the volatility surface, you can see that even though the volatility curve is inverted, there's actually a bid for volatility around the election. So at least some market participants are, in fact, thinking about the election as a catalyst for more volatility late in the year.
We're going to discuss the political outlook a little bit more in about 10 minutes' time. Just a recap of where the Dow stands, up 1,250 points, almost 5% with 90 seconds left. What's happening in the NASDAQ, Bertha?
Well, we've got the NASDAQ moving higher here, and really in no small part because of Apple. Apple now positive for the year as we go into the close on pretty strong volume. That has lifted the NASDAQ 100 into positive level for the year as well after having wiped out all of those gains last week. Tech and biotech are just as strong. Take a look at some of the biotech names that are strong. Those CEOs sitting down with President Trump at this hour to talk about the situation on coronavirus. And also wanted to point out that a number of the the JD.com and the Chinese names are moving higher today. JD on stronger earnings and lifting its outlook. That's a delivery, online delivery and a commerce platform. Meantime, we also have Iqiyi and Bilibili, which are entertainment. That stay-at-home trend in China, pretty strong. Over to Bob.
Global fiscal stimulus, central bank rate cut hopes, and of course very oversold conditions. That's what's contributed to this enormous rally. 1,000 down, 1,000 up. Just want to show you Walmart. Walmart was 119. January 19th went to 104. Now it's 115. Look at this. It's come 75% of the way back. A lot of stocks like Microsoft, same thing. They're back 50 to 60% of the losses we've had in the last week and a half. There is the closing bell. We're going to close right at the high. The Dow Jones Industrial Average closing up 1,282 points. The S&P up 4.5%.
Wow, 5% higher for the Dow. If you're just joining us, welcome to the closing bell. I'm Wilfred Frost.
And I'm Sarah Ivan here with Mike Santoli, as always, CNBC Senior Markets Commentator.
Let's check in on those market closes. 5 full percentage points higher for the Dow after last week's torrid declines, up nearly 1,300 points in point terms. S&P, NASDAQ all taking part as well, both up about 4.5%. Every sector on the S&P meaningfully higher, even energy, even industrials, which had been briefly in the red about an hour ago, up close to 3%. Utilities, staples, and technology lead the charge higher. Joining us to talk about the market day, Oliver Perscher from 1879 Advisors, Mark Lehman from JMP Securities, Peter Caccini from Cantor Fitzgerald here as well. Mike Santoli, first of all, to you, I mean, 5% gain for the Dow. Talk us through what stands out for you.
It's pretty stunning. I mean, if last week you were saying, wow, those sinister, systematic traders that just use the machines to liquidate stocks into a weak market, and we got down 12% from the highs automatically, and then you get into a new month, and we've run it in reverse. And I think some of it is the market absolutely overshot to the downside there. Investors very desperate to sniff out a climax of the buying frenzy in bonds. We might have seen something like that today. So I do think the combination of just these deeply oversold conditions, a high liquidity environment, and people being able to bet or willing to bet that last week was a big overshoot and a head fake, and we had a climax of the panic. I think you don't want to see the market pop 5% in a day and from that moment on conclude, aha, the coast is clear, a healthy environment.
Well, and it's a really important point because some of the biggest up days have happened during crises or going into recessions because the technical damage just becomes so great that they're buying opportunities, Oliver. So how would you advise your retail clients on that?
I would say this, that when the dust settles, and it will settle, and we're going to get clarity, what's going to come down to is earnings. Corporate earnings, corporate earnings, corporate earnings. We had effectively no corporate earnings growth last year. And now it's questionable as to whether we're going to see some this year or not. So certainly you want to focus on growth names. You want to focus on strong balance sheets. You want to focus on dividends, because that's where you're going to get the rise from, apart from the volatility and the bounce backs. And so to us, it's going to be a question of, are we going to be able to see earnings growth in 2020? And if not, valuations are still high if you're not seeing earnings growth.
We're up 1294 points today on the Dow. Since the intraday low on Friday, up over 2,000 points. All of the major averages have recovered more than 40% of their losses since the 19th of February. Peter, what does that scale of rebound say to you? Are you telling your clients tomorrow morning to increase their protection based on what you were telling us 5 minutes ago?
Yeah, I mean, there's something called a bear market bounce. And as you know, again, I've not been constructive on markets of late. And I believe it was Mark who just said we need to see some earnings growth. We didn't get any in 2019. And the coronavirus has led us to downgrade our S&P earnings forecast to down 5% from flat on the year. And at that level of earnings for 2020, we're still at about 20.5 times earnings. So when you combine that with all of the other uncertainties and the lack of policy space that the Fed and certainly other central banks have, I just think it's really, really tough to see equities approaching their old highs. So at 3,200, yes, we would be resetting protection for sure.
So, I mean, where do you think the market goes from here then? If not up to new highs, do you think it has further room to fall, or we sort of hover around here until we get more clarity?
Well, I think it's folly to try to predict the next 100 points in a market where volatility is implying a 2+% move every day. But again, from the technical levels we're looking at, from the vol surface, some other hints from flows, I think 3,200 is an interesting place to start lightening up again or hedging portfolios pretty aggressively here. Again, fundamentals have not been supportive of this rally for some time in our view.
Mark, what's your take on the scale of today's bounce?
Well, obviously it's impressive. We 2,000 points off the bottom midday Friday is unbelievable. What I was taken by, I spent some time with portfolio managers over the weekend and on the phones this morning, and everybody was pretty engaged in seeing what they want to pay attention to for the rest of the year. This is not a market where people are throwing everything out, and I think there's opportunities that are created. We had a couple of M&A trades, as you saw in healthcare today. We have some IPOs that have been filing. I'm looking forward at when this coronavirus news really gets out there and we know the gravity of it, and I think we're getting closer to that. The government is talking. We heard people like Anthony Fauci and others who talked over the weekend. They weren't exactly downplaying it, but they weren't saying this is kind of Spanish flu too. So that got people excited, I think, over the weekend. And I think investors were paying attention. I think for at least the time being, we need this volatility to temper a little bit, but I think we've seen the bottom for a little while here, unless we see an enormous spike in deaths, which I don't predict.
Mike, if you look at the sectors that took us higher today, utilities on top, then technology, that one was beaten down, but then staples and real estate. So there was still a defensive tilt on lower yields, perhaps.
There was. I mean, technology is interesting. I mean, Apple up 9% in a day. It's just kind of phenomenal at that market cap level. And so that's understandable. That's the old favorites. Within staples, though, Sarah, what was interesting is it was Costco and Walmart. Yeah, so you're kind of talking about the hoarding trade is working at this point. At least that was the instinct. But it does make sense. If basically your kind of keep it simple, stupid thesis about the market was stocks overshot to the downside, relative yields make stocks look much better than bonds. Those are the kinds of names. If you're not really sure about how many quarters we're going to have impairment of growth, if any, then I guess it makes some kind of sense to have that leadership profile.
Clorox also had an 8% up day. Bleach is in demand.
Mike, just in terms of the other things that are kind of confusing to look at, gold higher today. I mean, in terms of looking out for things overnight or tomorrow morning that could suggest this rally is only temporary, is that something that's matters?
I wouldn't ascribe a whole lot of wisdom to the day-to-day moves in gold. Everything was up today. I mean, oil bounced pretty hard. I do think that dollar backs off and gold is going to get a little bit of a bid. So I'm not really going to pick it apart on that level. It's much more about did we see real genuine demand at work today, or was it a lot of whipsaw activity? And essentially, like I said, just kind of relieving some of the overstressed conditions that we ended last week with. Not to say it's a head fake, because honestly, the early morning Friday lows in the S&P around 2850, that's the one to work with for a while. You got to assume that's the trading low for a good while. But guess what? What are you 240 points above that right now? So, and the S&P.
Let's talk about that big turnaround we saw in the bond market. Yields hitting all-time lows earlier in the session, but have now bounced back to higher levels. 115 on the 10-year. Rick Santelli with more on the bond market action. Rick.
Well, you know, bonds aren't closed. They'll be trading for a while longer, but how exciting. 2 years right now are at 89. A minute ago, they were at 91. That would have been unchanged. And if you look at 10s, let's show a 24-hour chart. Yes, we had a 102 handle before the sun shined in New York. And unchanged would be 115. We were briefly there. We're at 116. It's easing back a bit. The only maturity that looks like it really has a chance, 30-year bonds, they're trading 170 to sell at 168. Why is this so exciting? Because this would have been the 8th session in a row of lower yield closes. So it looks as though maybe the long end might break that finally. If you look at a 3-day dollar index, it's lost 2.5 cents in 3 sessions. It has been huge. And finally, 10s minus boons. Our rates are going faster than Europeans' rates, which is narrowing the spread to 173, the narrowest it's been, going all the way back to September of 2017. Sarah, Wilf, back to you.
I just want to follow up on that, Rick. The significance in your eyes that we've broken that 7 sessions in a row of a lower closing yield, clearly today slightly higher, albeit not much higher. I mean, how significant is that to you?
Well, I think it is significant because now we can start to maybe make a consolidation pattern. But in the grand scheme of things, Wilf, it would have never happened if we weren't up 1,200 points in the Dow Jones Industrial Average, or big days in the NASDAQ or the S&Ps. So we want to continue to watch how the equity markets is helping to fertilize some confidence that it isn't going to be all buyers thinking that the world's going to go end with regard to buying sovereigns across the globe, especially in the U.S.
Yeah. Rick, thank you. Mark Lehman, how important is it to you, the action in bonds, and to see a move like this in yields today, or to get them to stop falling at least?
Well, I'll quote Rick. I think he had a good point. One of my mentors once said, don't invest for the end of the world because it only happens once. And I've been through a lot of corrections. That hasn't happened yet. I don't think this is it. And I like seeing the yields go higher because it does tell you that the fear trade is kind of abated a little bit. So Mike said it as well. He said all asset classes were kind of up today, and last week all asset classes were down, and those are rarely good signs for predictions. But the bond trading higher is a good sign. I think it just tells you that the fear, the biggest fear, I think, is behind us. And again, I think once we see some rationality, some numbers, albeit bad numbers with the spread of the virus, but containable numbers, I think the market's going to be happy with itself in that 2850 low that we talked about, maybe the bottom for the time being.
Let's get an update from Washington. President Trump and his coronavirus task force have been meeting with top pharmaceutical executives at the White House this past hour. Let's get to Meg Terrell with the latest. Meg.
Hey, Sarah. Well, our Eamon Javers is in the room there and sending us dispatches. The CEOs of Regeneron, Gilead, GSK, and others, as well as research chiefs from Pfizer, J&J, and Sanofi Pasteur, all there to speak with the president and the coronavirus task force. Now, the president asked the executives, according to Eamon, if the competing drug companies will work together on a solution, to which they responded they would. Companies emphasizing their experience and ability to get this work done. Regeneron CEO Dr. Len Schleifer detailing the company's experience developing an Ebola drug, which they were successful at, while apparently acknowledging some of the industry's reputational problems, saying, quote, this industry is really talented as an industry. Sometimes we run astray, but we're going to get this done. And remember, guys, the president said this meeting previously was scheduled to be about drug prices. So there is some tension with an industry he's depending on for solutions while also trying to get them to dramatically lower their prices. Guys.
Meg, I guess the key question coming out of this is, does it meaningfully change the timeline for when we might see either something that can treat the virus or a vaccine to prevent the virus?
Well, the companies are already working just dramatically quickly. I mean, these timelines are ones we've never seen before. Moderna already delivering the first batch of its vaccines to the NIH to start human trials. It only took them 42 days to get there from identifying the target on the virus. That is just unprecedented speed. We are hearing potentially there could be another funding request coming out of this meeting. We'll see if these companies do get some more government support. Interestingly, from reading the reporting coming out of the room, it sounds like the president is trying to parse who's going fastest, almost pitting the companies against one another, even as he's asking them if they're going to work together. So the timelines are already pretty fast, but we'll see if this does change anything.
Meg, thank you so much for that. If you are just tuning in, the Dow rallying to its best point gain in history and up more than 5% in percentage terms. Huge gains, up now more than 8% since its intraday low on Friday. Let's get back to Bob Pisani. He's on the floor of the exchange with all the key takeaways from a resoundingly positive day of trade. Bob.
Yeah, and hopes for a global fiscal stimulus, hopes for central bank rate cuts, and some crazy oversold conditions, which now may be overbought, all contributed to one heck of a rally, closing right at the highs, up 4.5% on the S&P. Just let me show you some of the key movers here, because some of the most beaten up names outperformed a little bit more, but virtually everything was up. You could look at Apple and Microsoft in technology. You can look at Walmart and Merck among them as well. Even Exxon had a pretty good day overall. That's certainly very important here. I want to just show an example of how crazy things have been. Walmart is a good example here. Walmart was 119, February 19th or so. Went to 150, went all the way down to 104. $15 on the open on Friday, and now has come all the way back, essentially, and that's an amazing move. Almost 75% of the losses have been regained, and this is what happened with many names like Microsoft, for example, also moving rather dramatically. There you see in the last few days, look at that. That's almost 75% of the losses have been regained there. Another thing that was very encouraging today for me was the bank stocks. So they have been dramatically underperforming. Even in this crummy market, they've been underperforming. Citigroup, Regions Financial, Fifth Third, KeyCorp, Comerica, they all did better than the overall market, and that hasn't happened in quite some time. So oversold to overbought, 2,000-point move in the Dow. Maybe not quite overbought, but certainly 2,000 points in the Dow in the last 2 days can qualify as quite a rally. Guys, back to you.
It's stomach churning is what it's been. Thank you, Bob Pisani. So, Oliver, Bob mentioned some hopes of monetary stimulus. We've talked about that. Yep. What about fiscal stimulus? What's realistic in terms of expectations there in the U.S. and outside?
Well, I think there's a better shot in Europe than in the United States. At the end of the day, fiscal stimulus is going to require Congress to come together, and that's hard to see in an election year more than anything else. So I would say that shouldn't be what the market should hold its breath on.
Albeit Italy having to apply for permission from the European Commission to break its budget on a debate they've had for years, and it's not going to be groundbreaking in size when it comes. I don't think Germany's going to deliver a big fiscal expansion amidst the leadership crisis. So I don't know. It's tough to see anything that really...
I don't think anything moves the needle. I agree with you on that. But
by the way, another example that the Fed, all it has to do is send a message. It doesn't have to do anything, and the market sort of says, fine, they have our back. I really would imagine that the hopes of a intermeeting rate cut are probably out of the market right now at this point.
Peter, I know you're bearish. If you had to buy one U.S. sector, what would it be?
Well, we've liked the REITs for some time. The IYR ETF has been a great way to express that, and we've liked that for some time. That performed well today as well.
Yep, up 5%, along with the overall market. Oliver, thank you.
Thank you.
Mark Lehman, Peter Cicchini, thank you all for joining us on this historic rally day. Part of today's big turnaround, central banks around the globe are hinting at taking action to mitigate potential economic fallout from the coronavirus after China cut its rates in February. Earlier today, ECB saying the governing council, quote, stands ready to adjust all its instruments as appropriate. The Bank of Japan said it will monitor future developments and will strive to provide ample liquidity. And, of course, Fed Chair Jay Powell issuing a statement, a pretty unprecedented one Friday, saying we will use our tools and act as appropriate to support the economy. Goldman Sachs chief economist Jan Hatzius just told us he now sees the Fed cutting 100 basis points.
Wondering whether there's any talk about companies cutting their dividends at this point.
These moves may be just symbolic, especially when the markets realize how little central bank ammunition there actually is. Joining us is Sarah Bloom Raskin, former Fed governor and deputy Treasury secretary. So, Sarah, first, what are your expectations for the Fed at this point? What are they going to do?
Right. Well, the Fed has really put its cards on the table, given this coronavirus, and has indicated that it's going to pull out all stops. So it has done what other central banks have done. They've actually said it in a kind of coordinated way as well. So they are indicating that they are standing by and ready to take action.
Are they right to be doing that, Sarah, given the current nature of the threat to the economy and the markets?
Well, I'm not sure what they're going to do is actually going to have any long-term significance. Remember, they've got a pretty short runway to work with, so it's not as if it would be some kind of dramatic rate reduction, right? But they are indicating that they are standing by and ready to take action. And I think that that is an important symbolic statement. Markets clearly have reacted to that statement, have indicated that they are pleased that the Fed has engaged with that reassurance. But when it really comes down to it, the question is, does the coronavirus, particularly a potential pandemic, really care what the Fed is going to do? So we still have yet to see these cases coming in. The numbers are increasing. It doesn't appear as if it has bottomed out in any way. And so query as to what the Fed and monetary policy can ultimately do to deal with a potential pandemic.
But that doesn't mean that they weren't right in doing it, does it, Sarah? I mean, I get the argument that they can't obviously deal with the virus and the uncertainty that that'll cause and the economic damage. But if we really are talking about a behavioral shift hurting consumption in this country and services in this country, the demand kind of shock, I mean, then the Fed would be right to step in and get ahead of it, wouldn't they?
They would be. And you're right that in terms of a demand shock, that is something that a Fed funds rate cut would deal with. But there's also a potential supply shock as well, right? So you've got this rare convergence of both a demand side shock and a supply side shock, which is not always the situation that a rate cut is going to do much to help with. So it's really a tricky situation. I'm not saying that it was inappropriate at all for the Fed to put out this reassurance. My point is only as to how effective it's actually going to be right now.
Do you think, Sarah, when we step back and we also factor in how the Fed decided to respond to the sell-off that we got when the trade war was being amped up, do you think they focus too much now on short-term equity market moves as opposed to long-term economic fundamentals?
Right. It's a great question because essentially what the Fed did during the trade war era was it indicated that it's willing to take preemptive steps, right? Just as you said, it's willing to say we're not going to wait till the actual full-blown harm occurs before we act. And that became kind of a precedent now that the Fed chair really might have to live with, which is that if he is in fact concerned about preempting possible economic harm that is coming, then clearly you take steps early, even before a full-fledged harm has manifested itself.
Isn't that what they try to do, though? Don't they try to get ahead of the curve?
They try to get ahead of the curve. They don't always succeed in getting ahead of a curve. And remember, it's very hard to project, in particular this shock, it's very hard to project what its effects are going to be and how effective a rate cut would be. And I think there's another component here, which is we've got to remember that we are already very close to the zero lower bound, right? So the runway is particularly short, and that has to come into the thinking of the Fed. In other words, how do we shepherd our tools so that we are saving some of our powder for a potential shock or downturn that comes later?
Sarah, thanks so much for joining us. Great to see you as always.
Great to see you.
Up next, find out whether the junk bond market is sending any warning signs to investors.
Plus, find out which FANG stocks famed tech investor Dan Niles has been buying during the coronavirus sell-off. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. after a historic day where the Dow gained the most points ever, almost 1,300 points. Closing bell. We'll be right back.
Do you have concerns about mild memory loss related to aging? Prevagen is the #1 pharmacist-recommended memory support brand. You can find it in the vitamin aisle in stores everywhere. Prevagen, healthier brain, better life.
Walking into a clothing store is a completely different experience for me now.
It's amazing. I'm learning how the brain works, but not just any brain, but my brain.
This is not just some temporary kind of fix. It's psychology.
Visit Noom.com and change your life for good.
Hi, I'm Barry Sloan with NewTek, your business solutions company. Does your business need money? Whether you need $15,000 or $15 million, you can count on NewTek. And with rates as low as 6%, you can see why so many businesses turn to NewTek. Contact NewTek, your business solutions company today.
At Fidelity, online U.S. stocks and ETFs are commission-free. And when you open a new brokerage account, your cash is automatically invested at a great rate. That's why Fidelity leads the industry in value, while our competition continues to talk.
The biggest problem that we're helping address is access to care. Doctor on Demand is available nights, weekends, holidays, on a mobile phone or on a website. So much of the value that telemedicine can bring is empowering patients to seek care when they need it. The opportunity for our overall healthcare system is to deliver all the healthcare virtually that can be delivered virtually. That'll reduce costs, increase quality, and drive satisfaction for the doctors and the patients. This is the future of business. I watch CNBC.
Hey, guy, ED issues? We got this. Today's your day. Go to forhims.com/ED.
At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month.
Visit Credible.com to see how much you could save.
I got things I want to do, but student loans were holding me back. Credible.com helped me save $600 a month with a great rate. Now I can go do what I want to do.
Visit Credible.com to see how much you could save on your student loans.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get your first month free. Visit trykiwico.com.
She worked with Travis Bass, Ricky Williams, Lex Hilliard, and Dennis Rodman.
Pro sports superfan scams athletes to score millions. All new American Greed tonight, 10 Eastern. CNBC. Get yours.
Welcome back. Stocks are surging here on Wall Street as investors try to recover from the 7-day sell-off. As you can see, up 5%, over 5%, 1,293 points on the Dow today. We're now up 8% from the intraday low on Friday, or over 2,000 points from that low, though, of course, still down from the February 19th high. Let's get to Meg Terrell for the latest on the virus outbreak, which, of course, has been the driving factor behind markets in recent weeks.
Hey, well, the case numbers continue to rise in the United States. In Seattle and King County this afternoon, reporting 4 additional deaths, bringing the total in the country to 6. Health officials are concerned about an outbreak in a nursing facility in a Seattle suburb where some of these patients were residents, and more than 50 residents and workers have shown symptoms. The total case count in the U.S. is now more than 100. And that includes the first case in New York City and new cases in Florida, Rhode Island, Oregon, and more. In Illinois, with 4 total cases, the Chicago Board of Elections discussing plans to keep voters safe, emphasizing the ability to vote by mail. In New York, new cleaning protocols for schools and public transportation, including using bleach. And in Washington state, plans for isolation centers. The spread, of course, also continues around the globe, with almost 9 times as many new cases reported outside of China in the past day as in China, according to the World Health Organization, which is most closely watching outbreaks in Korea, Italy, Iran, and Japan. The WHO says it still doesn't consider the situation a pandemic, noting 90% of the cases have been reported in China. Sarah?
Meg Terrell. Meg, thank you. We've got a market flash now on microchip technology. Josh Lipton with the details. Josh.
Yeah, so Sarah, Microchip Technology now issuing a warning here, saying that they are seeing, in their words, very weak demand in Asia, especially in China, driven, they say, by coronavirus fears. They also say their supply chain is returning to normal operations at a slower pace than they had expected. So they are expecting now net sales for the fourth quarter to be about flat sequentially. In early February, they had issued quarterly net sales guidance of about up 2 to 9% sequentially. They say they are implementing a strict policy on travel to and from affected areas. At this point, they say none of their 18,000 employees or their family members have tested positive for the virus. Of course, we have seen a range of tech companies at this point talking about how that outbreak is impacting business, from Apple to Microsoft to HP. Guys, back to you.
Josh, thanks so much for that. Down about 1.3% in after-hours trade. Let's get over to Mike for the third installment of his dashboard. Mike.
Well, talk about truth or dare. So do investors choose the kind of secure truth of high-grade bonds, or dare to go for extra yield in riskier ones? This chart shows the relationship between BB-rated corporate debt and BBB. So this is really just the borderline between investment-grade debt and junk debt. When this line is going up, it means that there's more yield demanded to take more risk. So essentially, that's when credit markets are weakening. When the line's going down, it means they're strengthening. So this was before today. And I think the relevant point here is there was nothing extraordinary about that level. It wasn't as if the credit market was panicking commensurate with the equity market. And by the way, today, credit rallied very hard in line with equity. So this line would have come down. That's kind of reassuring, because it suggests that corporate bond investors, at least, were not seeing the coronavirus outbreak or any of the implications as saying it was going to be a deep and lasting economic impact. So right now, this goes in the column of factors that are confirming that the equity market, is decently supported around these levels, as opposed to a reason for fresh alarm.
And Mike, overall, the point on credit is that we're nothing like anything that we saw in past.
Yeah, we're talking about within a relatively contained range here. If you look back at 2016, that was got a little bit hairy, and then this is 2011, right? That's the sovereign debt crisis.
Mike, thanks so much for that. Now, the White House meeting with pharma executives just ending. Let's go to Eamon Javers, who was in the room throughout the meeting. Eamon, what are the headlines?
Yeah, Wilfred, that's right. The president went around the room talking to each of those drug company CEOs, getting their take on where things stand. By and large, they all agreed with Dr. Anthony Fauci, who has suggested it will be more than a year before there's a vaccine for the coronavirus that's publicly available. Each one sort of described at which point they could get to phase 1 testing and how long that might take, and making the distinction between pursuing a vaccine here and pursuing treatments for people who are already sick. They say that piece of things can go much faster than the vaccination piece. I asked the president a couple questions when the meeting was wrapping up. One was, I asked him whether or not he sees a need for economic stimulus here to support the economy due to the virus. The president did not signal that he sees a need for an economic stimulus package here. He said the economy is very strong as it is. I also asked him if he saw a need for federal dollars to go to some of these pharmaceutical companies. Some of the CEOs in the room mentioned that they could use some support for building plants and the like, but the president made a joke saying, look, some of these companies are so rich they could lend the federal government money. So the president seemed to be wary of the idea of pushing federal dollars at these pharmaceutical companies too quickly or unnecessarily. He also did say that he is considering moving forward with additional travel restrictions to additional countries that have been hard hit. He didn't specify which countries specifically he's considering there, but said that is something he's looking to move forward with. And then finally, he was asked if he sees a need for a federal emergency declaration. He said he did not signal a need for a federal emergency declaration at this point, guys. So an interesting period of time with the president and the drug company CEOs going around the room one by one, and we'll see that video here momentarily.
So, Eamon, is there anything the White House can do to expedite these vaccines? Is there anything that the CEOs and the researchers were asking of the White House for help?
Well, the main thing seems to be clearing away some of the brush of sort of bureaucratic red tape, right? I mean, that was a point that was mentioned several times. The president told the CEOs, if you run into any hurdles or hiccups from the federal government, let me know and we'll clear those out of your way. But they didn't really talk in a level of specificity about what exactly the government can do there to lower that bureaucratic hurdle. The president just pressing the CEOs again and again, saying, we want this done as quickly as possible. The president also asked some of the competing drug company CEOs, will you guys be able to work together? And they all assured him that yes, they'll all work together on this. So there's very much a message here of unity and effectiveness, and the president pushing them to move along as quickly as they can, but no real specifics discussed on what exactly the federal government can do to make that happen.
Eamon, thank you very much for that. Now, markets surged in the final hour of trade today, with the Dow posting its best point gain ever, up more than 5%. Let's bring in our closing bell closer, Dan Niles from Alpha One Capital Partners. Dan, thanks so much for joining us. I guess, first of all, a step back, you were shorting companies like Apple before the sell-off last week. Why had you put the short on initially, and when did you cover that short, if at all, last week?
I think on February 10th, talking about the fact, we put out a tweet on February 10th talking about the fact that we were shorting stocks and Apple and its suppliers and the Qs. And, then we said on February 17th how that had ramped up to 50% of the portfolio was short Apple and its suppliers. And the reason was really simple. Apple had 15% of revenues coming out of China and most of their manufacturing. So it wasn't, that difficult, especially when you consider the exact same thing happened in 2018, where Apple pre-announced negatively off of China after running up to all-time record highs. So that's why we did that. We actually did end up covering Apple this last week, and we actually bought Apple on Friday. So, our belief was that investors are going to want to believe that 5G iPhones are great for the company, just like they wanted to believe that in 2018 before the stock went down 38% in the fourth quarter. And so we bought that one. And actually this morning we bought some Home Depot, some Caterpillar. So it went into the industrial space, home builder space. That should benefit from lower rates, obviously, on that side. And then we also bought Facebook, Amazon, and Google late last week as well. So we went from about 40% cash at the end of the day, Tuesday of last week, to now we're running, well below 20%.
Well, kudos for that. I'm looking forward to seeing your fund's performance metrics when they're released. I bet they'll be in sharp contrast to some hedge funds in the last month. Now we've seen such a big rally, Dan, over 5% for the Dow today. Are you going to flip those positionings again?
Yeah, this is what it comes down to, Wilfred. From our perspective, markets always overreact on the downside and the upside. So looking at a 5% rally today because of, the Fed and the G7 finance ministers getting together and maybe cutting rates, that can go on for a little bit of time. But ultimately, you have to look at the fundamentals. And global growth in the fourth quarter in China was the worst in 29 years. We talked about that in a prior tweet. U.S. growth wasn't that good. World growth wasn't that good. And so the fundamentals were weak before we ever got the coronavirus. The only thing that went up was stock multiples. Earnings growth last year in the S&P was 1%. So to your point, Wolf, yeah, we are looking to reshort names where we think there's some fundamental issues. But for right now, we think the markets probably have some more room to run. And we'll look at some of the same metrics we looked on the way down to indicate to us when to go ahead and start to re-engage those shorts.
On the Apple call, Dan, I can't even keep track of how many times you've shorted and then gone long and had this incredible move up 9%, which you called right. But I feel like there needs to be like a disclaimer of do not try this at home because you are in and out of this name so much. How are you able to flip on a dime the entire sentiment around Apple from a day-to-day basis?
Well, the great thing about Apple is investors sort of have this one-sided view on the company that it's a great company and the iPhone cycle is going to be phenomenal. So that's the backdrop. And you can't disprove that until we get to the fourth quarter of this year. So that's the underlying bid on the name. But you also know the fundamentals aren't that great. If you look at it last year, revenues were up 2%. That's it. The stock was up 80%. So the multiple went to a decade high. And so for us, it really comes down to if you're paying attention to what's going on with China in particular, you can trade Apple pretty effectively. Apple's our number one profit generator this year on the short side. We also happen to have made money on the long side, which is the same thing that happened last year. We made money on the long and the short last year. And so Apple's great in that sense where investors, when you know they have a one-sided view, you can take advantage of that by focusing on the fundamentals and trying to figure out when investors will have to focus on that.
Dan, how important is expectation for central bank action in terms of driving today's bounce and what you'll watch out for in the days ahead as to whether or not to change your tune again and start shorting the market?
Sure. It's a great question, Wilfred. I mean, I think what you saw was the market was sort of hovering around the unchanged line or so, and then there came out that news release that the G7 ministers plus the central bankers were having a meeting tomorrow. And then the market really started to go up. And if you look at this market really from the financial crisis, a lot of it's been driven by central bank intervention. I mean, the balance sheets of all the central banks have been expanding, incredibly. But I think Mike Santoli, you had him, talk about the credit markets. And that's one of the things that I'll be really watching is seeing, is there a rally in the market like Mike talked about happened today? And, does the credit market believe that things are going to be, continuing to get better? If there's a disconnect, then it's very easy to short things. I mean, if you go back to, earlier when the S&P was sitting at all-time record highs, oil was already down double digits. Copper was down, I think, close to double digits. Every market, besides the equity market, was collapsing already. And so, in my opinion, it was just a matter of time before the equity markets played catch-up, which they did last week.
So if you're sort of gloomy on global growth, why are you buying Caterpillar?
Well, because the thing is, I think if you look at Caterpillar, they have a massive dividend yield. The earnings have been coming down. But here's the thing. Each down cycle, they've been able to generate more earnings than the time before. So, for some of this stuff, you're looking at it saying, well, what's the risk reward? And with Caterpillar, if you believe that, the stock has been oversold to a level and compared to 1% or 1.2% Treasury yields, a 3% plus yield looks interesting, then you buy it. But, you got to remember, for us, we're not trying to chase stocks. We got in front of this back on Friday, and we were trying to position for a rally. And so for a lot of this, it's sort of pattern recognition, and you can go back to 2001 after 9/11, and you can see similar patterns developing. And so it's trying to, as I always like to say, right, we're trying to maximize our reward for the amount of risk we're taking. And right now at these levels, the reward is really high. Back in early February, as we said back then, the risk reward made no sense. And so that's why we look at Caterpillar and go, it's pretty interesting down here, especially with the dividend where it is.
Dan Niles, thanks for joining us.
Thanks, Sarah.
We've got some news to tell you about on Visa with a warning. Kate Rooney has that for us. Hi, Kate.
That's right. Hey, Sarah. Visa is now the latest payments company to cut its outlook due to coronavirus. Visa now expecting second fiscal quarter net revenue growth to be approximately 2.5 to 3.5 percentage points lower than that outlook that they had shared in January. Visa, as well as MasterCard and PayPal last week, citing a slowdown in cross-border business, particularly that travel-related spending in both the card networks. So we had PayPal and MasterCard last week. We also spoke to Square, which has not cut its guidance yet. But all these payments companies monitoring coronavirus right now. Visa not updating its 2020 full year guidance, but they did say that they'll continue to update us, and they'll give that on the earnings call coming up in April. Back to you guys.
Okay, thanks so much for that. Mike, just a quick gauge here. 2.5 to 3.5 percentage points lower for revenue for the current quarter that we're in. For something that's so reliant on consumer spending, which is one of the areas people are fearful of with this virus. Sure. It could have been worse, this guidance.
Sure.
If it's one quarter only 3% lower.
Yeah, that's not a big deal because it is a very strong top-line grower, so it's not as if that's all of its growth going away. I also don't think it's obviously terribly a surprise because MasterCard said something similar. They're basically the same business drivers of both those companies with some slight geographic differences.
Anyway, after hours trade down 2%. Visa after, of course, a strong gain in today's normal session. The ECB just out with a new statement on the outbreak from President Christine Lagarde, saying the coronavirus outbreak is a fast-developing situation which creates risks for the economic outlook and the functioning of financial markets. The ECB is closely monitoring developments and their implications for the economy. medium-term inflation and the transmission of our monetary policy. We stand ready to take appropriate and targeted measures as necessary and commensurate with the underlying risks. And I guess, Sarah, this is nothing groundbreaking.
No, what's striking to me is that she's learned central bank speak very quickly.
Yeah.
Because that is all central banks speak for. We're here, we're ready, just like the Fed, just like the BOJ. We're watching, and we're going to try to come to the rescue if we can.
And I just go to that, what we discussed with Jan Hatzius earlier today. He came in to say up to 1% of cuts from the Fed this year, 10 basis points from the ECB. Goes back to the point they have no levers to pull, and that's one of the reasons we've seen the euro rally so significantly in the last week and a half is that there's not much they can do relative to what the Fed can do.
But they'll try anyway.
They'll try, and they stand ready.
But they'll hope words are enough.
Well, that's
as long as
your
possible.
point,
Yeah.
right? And it's helping.
Yeah, so far.